Good afternoon. For those of you who I don't know or who don't know me, I'm Neil Kashkari, President of the Minneapolis Fed. Welcome to the first edition of the Macroeconomic Policy Perspectives Conference. Thank you for joining us, everybody here in the room and those who are joining online. This is a joint initiative between the Federal Reserve Bank of Minneapolis, the University of Chicago, and Stanford University in collaboration with journal Political Economy Macroeconomics. So why are we doing this? Why did we decide this? Our goal is to bring together leading academics and policymakers to share insights on relevant policy questions in an annual event. We felt it was important to include a policy panel, and I'm looking forward tomorrow to moderating a conversation with Professor Diamond from the Chicago Booth School, from Dr. Shin from the BIS, and Professor Eisfeld from the UCLA Anderson School of Management. Now, our motivation here is that almost 15 years after the global financial crisis, and a lot of subsequent regulatory changes, the banking system in the United States and abroad still shows vulnerability to sudden disruptions. The financial system broadly, if you think about when COVID hit 2020, massive financial disruptions that were not focused on the banking system, but then in March 2023, with Silicon Valley Bank and Credit Suisse, those were acutely focused at the banking system, showing real vulnerabilities. So the key questions that we want to explore together are, what remain the sources of macroeconomic, what are the sources and macroeconomic consequences of banking fragility? How does the financial infrastructure, including the interbank market, affect monetary policy? And is the current regulatory landscape appropriate to ensure a resilient financial system? Now, there are some research topics that will be analyzed these are some of the research topics that will be analyzed at the conference. After several years at the Minneapolis Fed, I have learned, this is my 9th year, that there really is a fundamental connection between research and policy. That research without policy can be sterile and a little bit, dare I say, not that relevant. And policy without research can be flying blind. And so we really need each other. And this conference is meant to continue to build bridges between these communities. Together, I believe that they can continue to make the economy more resilient and more vibrant, and ultimately living standards better for all of our people that we are charged to serve. My hope is that this conference today will be the start of a tradition of bringing research and policymakers together, contributing to learning and solving economic issues for many years to come. I look forward to the conference proceedings today and tomorrow and seeing what this initiative develops over many years in the future. So thank you again for being here. With that brief introduction, I'm going to turn it over to my colleague, Javier Bianchi, who is going to moderate the sessions this afternoon. Javier.
Thank you, President Kashkari. We're going to get started. So the first paper is going to be assortative matching, interbank markets, and monetary policy. The presenter is Rustam Janilov. And the presenter is going to have 40 minutes, followed by a discussion of 15 minutes and 5 minutes or final questions at the end. We're going to be allowing for some questions throughout the presentation. And so let's get started.
Great. Thank you very much. It's a great honor to be the first presenter of the first edition of this great conference, and thanks a lot to the organizers for putting up a great program. This paper is on interbank markets. The usual disclaimer applies because Christian Bittner is part of Deutsche Bundesbank. The motivation for this, the applied motivation for this paper is on the prevalence of bank dependence in Europe and throughout the world. A little bit less so in the United States, but for Europe it is a very salient feature of the data. And also dependence on interbank markets as well. So here I'm showing you just a general overview of interbank loan and borrowing dependence across European countries. So there is a lot of heterogeneity, but on average, the dependence is quite high, so it's about 8 to 10%. For some countries such as Germany, here on the right, I don't think it works. Here on the right, the last columns, so the dependency is quite large, so it's around 13%. It means banks on average lend and borrow on the interbank market of around 13% of total assets. So that's still that's a big market for Germany for a lot of context as well. So That's our sort of inspirational or empirical motivation to write a quantitative theory of interbank markets. We start with bank-to-bank linked credit registry from Bundesbank, and we merge that data set to various balance sheet and income statement items in order to understand the market a bit better. Motivated by our empirical findings, we will be developing a quantitative macro model with heterogeneous intermediaries. The complication in the model is that banks face uninsured idiosyncratic deposit withdrawal shocks. So every period, banks will be facing a liquidity problem that they have the option of solving through the frictional interbank market. The non-trivial aspect of our model, as you will see, is that when banks are heterogeneous, ex ante and permanently, clearing the market is not trivial. So we develop a clearing algorithm that is very scalable and can accommodate thousands of individual banks. So just a short preview of some of our main empirical and quantitative results. A stylized fact, not just for Europe, but also around the world for the United States as well, that the number of active registered banks is declining over time. So the concentration, not just in banking in general, but in the interbank market is rising. In the cross-section, we observe a very strong size-based trading pattern, that larger intermediaries, everything else equal, trade more. They lend more and borrow more. Moreover, there is sorting. They are much more likely to match with other big intermediaries. So there is size-based trading, but there is also concentration in the top sales from both the lending and the borrowing side. And the interbank market responds systematically to transitory monetary policy shocks, in particular. The size dimension and the assortative matching dimension is important to understand the heterogeneous effects of the transmission of monetary policy. So if we are to have a realistic model of the banking cross-section, which we believe is part of the data, and if we are to have a realistic interbank market, we need to take into account these data features. So we do that in our model. We calibrate it along several dimensions to match various moments of the German data, both unconditional and also the conditional impulse responses. And we document that the assortative matching aspect of the model that we see in the data is inefficient. So there are potentially gains from trade if banks were not sorting based on size. So we discussed the implications of the model for secular trends. Even though it's not really a trend, it's not a paper based on trends. We're interested more in business cycles. But we can speak on trends, but we mostly also focus on monetary liquidity policy. How does the tightening of reserve requirements, for example, propagate across the frictional interbank market? That's something we can test. And finally, hopefully I will get time to talk about it, we have an extension with imperfect competition on the deposit market, and we show that extension interacts non-trivially with the interbank market. So on the literature, so we're sort of combining for literature strands. We're contributing and building on the heterogeneous intermediaries literature, which has been expanding in recent years. We're contributing to the literature that studies bank liquidity problems in general form, over-the-counter markets, but also interbank markets in particular. Our algorithm is inspired by Atkinson-Borstein, and I will be more specific. What does that mean? And we're also motivated and contributing to a huge empirical literature that studies monetary policy across European and Euro area countries with a specific emphasis on interbank markets. Okay. So let me go through the data just to show you exactly what we're working with. We have the universe of bank-to-bank exposures from Germany, we're considering all banks domiciled in Germany, meaning that we are considering German banks and also foreign banks with a legal subsidiary in Germany. We have quarterly frequency over the past 20 years. We have a good coverage every quarter and around 28,000 observations. We have lots of types of banks, and that we keep them all from the beginning to exploit some potential type heterogeneity later on, but we'll also be removing some of the less traditional types of potential building societies. We'll be removing later. And as mentioned previously, we merged this registry with monthly balance sheet statistics and annual profit and loss statements. Okay. So this is just a broad overview of the market over time. So this picture plots the volume on the left axis and the number of banks on the right axis. So this is specific to the market, but the number of banks is also super highly correlated with the number of banks in general. Because conditional on existing, most banks always tap into the interbank market over time. So as the number of banks has been declining, the number of banks participating in the interbank market has also been declining, and the total volume has been going down. But interestingly, there is a strong cyclical component. And in the end, and this has been reflected in policy dialogues around Europe, that there is an uptick in the relevance of the market. So the trend is not so obvious. So we're not that far off from early 2000s. So the second empirical fact that we're using as motivation for the model is the size-based trading observation. So here I'm showing how in the cross-section how bank size proxied by total assets, but you could do total deposits or equity that doesn't change, how it's strongly correlated with the volume of loans and the volume of borrowings in bank-to-bank transactions. So, and that's controlling for the time fixed effect. So we're analyzing things within the years, within the same year. Okay. So, yes, of course, yeah.
Is it true to control for total borrowing? Because that there is a relation between size and borrowing. I mean, any type of borrowing, I imagine there's a relationship. But I mean, is it true also interbank over total borrowing?
If I control for what?
In the y-axis, instead of have just interbank borrowing, just to have interbank as a share of total borrowing.
Yes, I do have that. I don't know how to click it. That's exactly why I have this link. So I will tell you what happens. So for borrowing, there is the same pattern if you look at the share of borrowing as a share of total asset. So that's the same, but not for lending. So the relationship is flat. So in terms of intensities, this fact is less robust. In terms of levels, this is super robust. Okay, but so that was a useful fact. But this is sort of the key empirical finding that we're trying to document is the assortative matching. So I show you these matrix-like figures where you have the size of borrowers on the x-axis and the size of lenders on the y-axis. You have this concentration of circles. These circles they add up to 1. So in each picture, the circles, they add up to 1. That's the total interbank market in the country. And the bigger the circle, the bigger is that particular bean-to-bean interaction. So while it's true that the bigger banks lend and borrow more, but they also link to each other a lot more. And I have detailed sorting tables where we can estimate probit models, like the probabilities of bank-to-bank matches in the top, if both of them are in the top decile. So it's all in the paper as well. Yeah.
Just to make sure I understand, if I take probably the fraction of borrowing by a big bank that is against another big bank compared to the fraction of borrowing by a small bank that has an interparty of a big bank, is that bigger? Because From that picture, the only thing that I learned is everybody trades with the big banks.
So it's hard to see, but these circles are monotonically increasing along both the horizontal and vertical dimension, and they're the largest in the top right corner. I have a table also in the appendix of the paper where we show numbers. And we show likelihood matches weighted by the number of connections and also by the volume of connections. And it's not just size-based training, it's sorting is also there. But that's a very good point, because it's not because these are two completely different things. Okay? And the result is robust before and after the great financial crisis. And you can say that maybe the result is driven by some weird, Germany is very peculiar in its banking sector. There are lots of interesting types, but they're small in scale. So if we exclude development banks, building societies, the result do not change. So if you just look at standard commercial banks, it's still there. All right, so now we're moving towards conditional analysis. So we will define what we mean by monetary policy shocks. So these are the standard Dzerzhinsky and Karady surprises that are being cleaned out from the information effect. So they're very standard shock series. And this is the time series of the interest rate corridor, the deposit lending facilities in Europe, the main refinancing rate, the interbank rate, as well. So I will be coming back to that figure later as well. So what we'll be doing is very simple, very standard lag-augmented local projections, where we're interested to understand the response of bank-to-bank transactions, both in terms of the intensive margin measured by the volume and the extensive margin measured by an indicator variable, whether you're connected or not. And we want to see how that responds over time to a monetary policy surprise. We have some controls, and we have fixed effects, and we have a very conservative way of dealing with standard errors. So that captures the average effect, the beta coefficient. That's the average loading on the monetary policy shock. But we can do more. We can study heterogeneous effects. We can condition on banks being in the top decile of the lending and the borrowing distribution of the interbank market. So now we can also look at heterogeneity as well. So just to show you some impulse responses, that's on average how the interbank market reacts to a surprise monetary policy tightening, that is, interest rates are going up. So when interest rates are going up, the volume and the number of transactions in the market go up. So that's interesting because normally when you think of a bank level analysis, you think of monetary policy tightness as a contractionary shocks. So to generate that in the model is not difficult, but to generate this in the model is not easy. So I will show you how to do that. So you need to have a situation where a tightening simultaneously contracts the economy but increases interbank market activities. So, yeah.
To help understand these results a little better, are we talking about overnight interbank repo, or are we talking about long-term loans? Like, what are these?
Very good, very good. So unfortunately, we don't see the composition. We see total exposure. So 80% of it is short-term bank-to-bank, interbank loans and borrowings. But it also includes bond exposures. So we have like total exposure. It's a portfolio problem. We observe total portfolios of Commerzbank and Deutsche Bank, but we're not allowed to see the composition.
Different periods in which the amount of excess resource in the banking system was different, so pre and post quantitative easing policies?
We haven't tested that.
Okay.
We can't look at it. So what we know that the result is robust to the inclusion of various controls, so we don't have the bad control problem of any kind. We are robust to the inclusion and exclusion of various types of banks, but we have not done it for different time samples. We can. It's going to be a little bit more noisy because of the zero lower bound. So, but now with the with the various empirical innovations, we can actually test the responsiveness to non-conventional monetary policy shocks as well. So there are forward guidance surprise shocks as well, public level, so we can potentially do that too. Okay, and so so in addition to the interbank market of expanding along the intensive and extensive margins, the expansion is concentrated in a particular segment of the market. The expansion is concentrated in the top right corner of the matrix that I was showing you. The overall increase in connections and volume is driven by the sorting of the big banks. All banks trade more, but the big banks trade even more among each other. So again, just to motivate you that our model has some relevant features, and we will, to a large extent, we will be able to match this as well. So, yeah, this impulse response. So just to take stock before moving on to the model. So a very good question to ask. Why is important on why is a paper on a market that is dwindling in size over time first order? Well, it's declining in size over time, but it's still about 1.5 trillion euros. So it's not a trivial market. So it's still very important for the German economy and for Europe as well. We find strong evidence of assortative matching, which I don't think, actually, I think it's a more general result than just for Germany. So we have heard from colleagues from Bank de France and Bank of England that this is also true in some other, but I'm not so sure about the American economy. So maybe I can get some feedback on that. Yeah, we also documented some conditional responses. Okay, so now, motivated by these facts, we're developing a quantitative model where there will be some standard features. So the firm sector, the household sector will be very standard. There will be representative agents. So the complication will be on the financial side. We'll have a discrete number of banks. That's very important because I cannot handle, the algorithm cannot handle a continuum of banks. I will show you why. We have a discrete number of risk-neutral banks indexed by J. So they will be ex-ante permanently heterogeneous in some cost efficiency. You could think of it as some isomorphism of TFP. Okay, but it's permanently assigned by nature, and that it doesn't change over time. In complete markets and uninsured deposit withdrawal shocks, so banks will be facing that within the market, within a period, every period. So it's a dynamic banking problem, but the interbank market is static. So that's what we do. Okay. The interest rate corridor policy, the reserve requirement, all policies will be exogenously assigned and taken directly from the data. So conditional on the German data of the policy corridors and all policy instruments, we will have a model that will be calibrated to the interbank market, and we'll see what happens. Okay. Yes.
Withdrawal shocks, are they IID over time as well, or
yes?
What?
Yes. So the banks do not internalize the impact of their within-period interbank market decisions on the future day. They don't know. And that's a different statement to what you just asked about. The shocks are IID, and there is also this sort of externality of some sort. So this is the interest rate corridor. So all of this is all of these are policy instruments that exogenously chosen by the policymaker. The lending and the deposit facility rate. Importantly, we have a symmetric spread. We can handle non-symmetric spreads, but the spread is symmetric around the refinancing rate. And we impose the no arbitrage condition on the interest rates, which is standard. So the problem of the household, I will be very quick, so it's very standard. The household supplies labeling elastically. It's the final good. Has CRA preferences, they can save via bank deposits, which pay out as state non-contingent gross return. And they maximize their problem subject to the sequence of these balance sheet constraints. They receive dividends, so banks will be dying every period, so when they die, they will transfer dividends, the remainder of the franchise to the household in lump sum form. T stands for some lump sum taxes, and W is the competitive wage. And it loads on 1 because inelastic labor is normalized to 1. Okay? So we have 2 types of firms. The first firm is a capital producer. So there's a continuum of them. They're identical. They're indexed by I. So what they do is they, once they don't have internal financing of their own, banks buy claims on the capital stock. Those claims are bank specific, indexed by J, but they get aggregated to big L. So the firms intake the stock of L and convert it into capital with a concave production function. This is extremely useful, and I'll show you later, explain why, because the sufficient statistics, so to speak, to solve everything is aggregate L. Once you know the distribution of loans, you know everything in this economy. Because once you will know the distribution of L, you will know big L. Once you know big L, you can solve for the aggregate capital stock. Knowing the aggregate capital stock, you can solve for prices. And once you know both, you can solve for the return on capital. And the return on capital is the forward-looking price, conditional on which the distribution of banks makes its decision. So once you know RK, the expectation of RK in the future, you can solve the partial equilibrium problem, and then it goes. So that's why it's, yeah.
You had a deposit shock from the bank. Where do they go?
It's coming, yeah. So that's the non-financial side, representative, sort of quite very simple on purpose. Okay, so financial intermediaries, they accumulate net worth, and they source deposits from the household. They lend to firm. They buy claims, so I use that interchangeably, but they buy claims on the capital stock, and they have some reserves as. So I use the moral hazard approach from Gertler, Karade, Kiyotaki, and I will be explaining why exactly that's still important later on. So the idea is that due to moral hazard frictions, there is a cap on leverage that otherwise is unbounded in the basic model. There is a minimum reserves requirement that banks will need to satisfy by the end of the period every time. Because the constraint must be satisfied, that's why the interbank market will become interesting. And the law of motion of net worth is as follows. Conditional on some net worth today, banks will get the return on their claims. They will get the return on reserve holdings. So the R is the interest rate on reserves. That's exogenous. RK is endogenous. They pay depositors with the interest rate, but the interest rate is perturbed by this kappa object, which is the cost shifter. It's on aggregate, it's on average 1, but any deviation from 1 makes some banks more or less cost efficient. And finally, this final object is non-interest expenses, or you can think of loan rebalancing costs, which are convex.
Just a question, given how you formulate it, you don't have an issue of insolvency in this model, right? The banks are always solvent because of this constraint imposed, right? So they don't take any risk that could put them in insolvency position because of high leverage.
No.
That's why the depositors really don't care about bank solvency in your model, and just this idiosyncratic liquidity shocks.
So I deal with insolvency very carefully in a different paper of mine, H-Bank. So that there we take it very seriously. Here, that's not, we don't focus on that. Yeah. Okay, so this formulation is fairly standard. So it's a sort of Getler-Takakarada world. The non-standard aspect is the prominent heterogeneity in kappas, and what's coming now. On the next slide. So that's the dynamic banking problem, just in recursive notation. The only aggregate endogenous state that the banks need to keep track of is big L. Once you know big L, you know everything. There's no aggregate uncertainty. We're considering stationary equilibria and then transitions across them. But if we did have, that would be sufficient, and we have shown that in a different paper as well. Yeah. Yes. Oh yeah, it should be. Yes, it should be n prime. Right. Yes, very good.
So I'm a little bit confused. I thought you said, and you made a big deal out of this, that there were a finite number of banks.
Yes, it's coming.
But
next slide.
and these are exposed to some idiosyncratic
Yes.
shocks.
Yes. So
You're
this
not
is
going to be assured of any law of large numbers. So I don't know how to reconcile that with saying that there is no aggregate risk.
Good question. Yes, I agree. So
Answer may be
Yes.
forthcoming.
very good. That's very interesting. I haven't thought of that. So my naive answer would be as the discrete number goes to infinity, as if it's very large, then the problem is less severe. But for the number that we assign now, which is going to be small, it's going to be an issue potentially. Yeah. But yeah, that's a good. That's a good. So that's the dynamic banking problem across time. So I haven't said anything about the interbank market yet. So in every period, once the portfolio decision has been, once the lending and deposit choices have been made, the banks receive an uninsured idiosyncratic shock psi to their deposit choice. Okay, and so what happens is they will either have a deficit or excess in reserves. This delta object on the left will be zero whenever xi's are zero. So in the absence of if markets are complete or the volatility of the shock is zero, then the delta will always be zero, and there is no excess or deficit reserves that you need to take care of. But in any other circumstance, if you have a deficit, for example, if that delta is negative, by the end of the period, you have to close that deficit. So there will be two options. You can tap the interbank market. It will be fully flexible. On the next slide, I will show. Or you go straight to the central bank, to the lender of last resort. But there is a penalty rate. So in principle, you will always want to borrow from other banks. But because there are frictions, that will not always be possible. So an important assumption is that we are imposing that the interbank rate will always be equal to the refinancing rate. In general, it's not. It's a policy target. You want it to be. We are assuming for computational convenience that that the central bank always able to hit the interbank rate with ease. For the most of our sample, that actually is true. The correlation between the two, the Ionia and the interbank and refinancing rates is 99%. But it just, for clarity, that's our assumption. Okay. So how do we clear the market? We remember that we have a discrete number of banks, and we have these ex-ante efficiency types. We're ordering them in a descending fashion from the most to the least efficient one. So once the idiosyncratic shocks are drawn, we know the full order of both lenders and borrowers from most to least efficient. And Atkins and Burstyn do this very similar thing. That's how they solve their model with heterogeneous firms and the choice of heterogeneous foreign firms of entering domestic sectors. They order firms from highest TFP to lowest TFP. The high TFP firm goes first, chooses the sector and how much to invest. We do the same thing. The highest TFP bank, the lowest kappa bank will choose first. It will choose it will go down the pecking order of the potential counterparties one by one. You want to trade with the best bank, suppose for reputational reasons. If you're a commerce bank, you want to deal with other big banks because or you trust them more. If you trade or you satiate your demand, done. The round closes, and then the next borrower goes on, makes the decision and so forth. So the advantage of this approach is that it's very flexible and all sorts of outcomes are possible. We could have rationing, we can have sorting and so forth. It's also just 1 second, and it's also very scalable. So we can manage several thousands of intermediaries, but the disadvantage is that it's very sort of reduced form. So it's very specific. So, yeah.
So this algorithm is because banks are not allowed to charge different prices to different counterparties. You've set the price, and so everything has to go through.
Yes, and so the price is fixed, but the costs are match specific. So I'm getting there. So the cost of the trade, the variable costs are match specific.
But why would they trade at the same price if they have different costs and different benefits potentially?
Well, because the net benefit, if you're matched with a good bank, you're more likely to trade because, let me explain it to you. Okay, so we assume that there is some minimum volume cutoff, so like a quote-unquote fixed cost. So that helps us generate a region of inaction, which is very large in the matrix that I showed you. But there is also the match-specific variable cost function here. So it's convex in Q, and what we do is the cost function is a function of the ranks themselves. So if I'm a borrower of rank 1, I'm the most efficient one, and I'm trading with the lender which is the most efficient one, the two x's are 1, so the cost is as low as possible. But as soon as I become less efficient or my counterparties are worse, the variable cost explodes very quickly, and the trade becomes increasingly less likely. So what this is helpful for is that having both XB and XL, having the cost lender and borrower specific, that gives us sorting. Because it will only be lowest if both types are efficient. It doesn't work if you don't have this XB and XL. If you just have one parameter, you will have size-based trading, but you will not necessarily get sorting right. So so let me show you the steps. So the first round starts. The first ranked borrower starts looking at the first ranked lender. This is the cost of the choice. You want to minimize it, subject to the outside option, which is the lending facility rate, which comes at a premium, which comes at a penalty, so I would try to avoid that. So you have this 1 times this Q cost. The ones are coming because both me and the counterparty are the most efficient ones. So that's as good as it can get for me. The optimal Q star must satisfy the minimum volume constraint. At times it does not, so that the trade collapses, and so you get the extensive margin. And the feasibility constraint, because you cannot trade more than either me or my counterparty have in terms of demands. Okay? As a most efficient borrower, I go through all the lenders. At some point, I satisfy I fulfill my deficit, or maybe I don't. If I don't, I go to the central bank. If I do, the round stops. I need to keep track of all the deltas of every bank, every round. Okay? Then I iterate over all borrowers, so that's the outer loop. If a lender L has any surplus remaining, which happens often, they have to go to the deposit facility rate and park their reserves at a lower rate, so they're also interested in having more matches. And if a borrower has any deficits to cover, it has to borrow from the central bank and then the market closes. So when I say the market is flexible, is because you can have situations where everyone is happy. That's when costs are very low. You could have rationing of lenders, or you can have rationing of borrowers, or both. You can have regions of reaction or not. So it's And all you need is this duality in the cost function. So here is to illustrate so what I'm talking about. You have quantities on the horizontal axis and the total cost on the vertical axis. The solution is Q star. Right? So that's the solution to the problem you have just seen. It's a first-ranked borrower chooses how much to borrow from the first-ranked lender. I want to borrow more. At some point, I don't, because the convexity of the because you can assume that it's costly to monitor these transactions, and the costs are convex. At some point, the convexity kicks in, so there is always this local minimum, the global minimum, and you want to be at the Q star level. But Q star is, unfortunately, for both, is bigger. It doesn't satisfy the feasibility constraint. So it's bigger than delta L and delta B. So in the end, what happens is delta B amount gets traded. So it's less than what I wanted and what the counterparty wanted. So I'm done with the first lender. Then I go to the second lender. I take the difference for both, and then it goes on until the end. Okay, very good. So I spent a lot of time on this because that's the main contribution, and the rest sort of standard. So having, once we solve the interbank market, yeah.
One quick question. How is the interbank rate pinned?
Yeah.
How is the interbank rate pinned down? How is it determined?
It's, so we had it on the slide, so let me remind that it's always equal to the refinancing rate. It's the policy choice, so it's not endogenous. In a general sort of model like Bianchi-Biggio, it is endogenous and it depends on the market. So because we have this very complicated interbank market, so we wanted to keep things a little bit simpler in other areas. So now, so how do we, so we have this assortative matching thing, and then we integrate it to the dynamic banking problem through net worth. So the net worth could be higher or lower at the end of the period after the solution of the interbank market is known. So what we're really interested in is end of the period net worth, which could be lower than in the ideal world because the market is inefficient. Okay, and I will skip the definition of equilibrium. So we calibrate most of the parameters to the German data, and some parameters are standard, so I will not dwell too much on this, and it's sort of work in progress as well. So just to show you a few pictures, so these are stationary distributions of bank size at the bank level and in the interbank level. So we are not necessarily interested in matching the concentration, so we can do that, but here just to show that we get some realistic densities, both at the bank level and at the cross-section. We generate immediately size-based trading. So in the interbank market, bigger banks lend more and borrow more. For that, I don't need any assumptions on the match-specific cost function. And then we generate assortative matching. So these are the same, just different, slightly different style matrix-like figures, where you have a large region of inaction, and then in the top right corner, the connection between big borrowers and big lenders. You have some matches being formed. This is the extensive margin, and the intensive margin is on the left. So big banks lend and borrow more, and then they match more together. And for that, we need this asymmetry in the cost function, as I mentioned. Okay? So I think I will only have time to highlight this result, and that is the important one. So what we do is we just compare, very good, yeah. We just compare the allocations and equilibrium quantities and prices in the baseline calibrated model to the general economy and the counterfactual economy with no assortative matching. And what we find is that the frictional interbank market lowers volume by about 80%, net worth of banks by 5%, it increases leverage, and it leads to aggregate effects on output and consumption. So the whole economy is worse off. The banking sector is riskier, less capitalized, the consumers eat less, and we produce less. Okay, and we have other special cases which I'm going to just skip. Let me conclude. Yeah, I didn't get to talk about deposit market concentration. So to conclude, so we have this, we have a model. Our main contribution to relative to the literature, which is quite rich already, is the focus on sorting and size heterogeneity. The theory is calibrated to the German data, so it's driven by microdata. And what we're working on right now is bank-to-firm linkages and credit network formation.
Okay, thanks so much for letting me discuss this paper. And let me get started. So I have 21 slides I need to show you. Okay, so this is a paper about monetary policy transmission in the interbank market. Yeah. You could characterize the paper as Gertler-Kiyotaki, Gertler-Karadi meets Yankee Biggio meets Atkinson-Burstein. The main focal point of the paper is in the interbank matching market, showing that there is positive assortative matching going on. Okay, and the sorting happens according to an exogenous parameter, the efficiency of the bank. Okay. Now, the main characteristic of the matching market is that it is self-reinforcing, meaning that if you are lucky and you have drawn a high efficiency, then you will do well in the interbank market. You have a better outcome. This will increase your net value over time, which means that in the long run, larger banks are successful in the interbank market. Okay, and large banks lend and borrow from large banks. Okay. The authors simulate the results using German interbank market. Now, I'm a theorist, and this is an empirical paper, therefore, my main focal point will be on the economic mechanism in the theory and how it relates to the results. Okay, so let me quickly walk you through the model. The model is fairly standard. So you have a central bank that sets an interest rate corridor. You have Gertler-Kiyotaki firms, so capital goods firms take bank loans, produce a capital good. Final goods firms take the capital good and labor as input and produce a consumption good that is eaten by the households. Let me see if this works. There it is. Okay. Here are the households. So households consume, they invest in deposits, they earn interest on deposits, they earn wages and dividends from banks that exit the economy. Okay, so the focal point is on banks. Banks are Gertler-Karadi style to some extent, and then there's an innovation there. Okay, so bank balance sheets are standard in the sense that you have banks making loans and holding reserves. On the liability side, you have deposits and you have here net value. The banker can abscond with the money, which means that there is some constraint here on the asset holdings. I think this is the right constraint. So I corrected a couple of things while I was going through the paper. There's a reserve ratio requirement, which is important, and I come to this in a moment. It means that reserves at any point in time have to be a fraction, above a fraction of deposit holdings. Banks exit with probability 1 minus sigma in every period. And so here comes the important part. Banks are heterogeneous with regard to what the authors call efficiency kappa. Yeah, so this is once drawn and then maintained for the entire period or throughout every time period. And efficiency is important because it impacts the model in 3 kinds of ways. So the first impact is that if you look at the evolution of the net value of the firm, of a bank, so the bank earns returns on assets, on reserves, and then here, usually banks have costs for deposits. Yeah. And you see that the efficiency parameter reduces the costs to on the interest rate that banks have to set. Yeah. So the higher efficient the bank, which means kappa is small, the smaller the costs due to deposits. Okay, that's the first effect of efficiency of the bank. The second effect is on reserve settlements, and the third one on the matching priority. Now we'll come to this now. Okay, so the paper then goes away from Gertler-Karadi and more towards Yankee Biggio. You have the banks, and banks incur deposit outflows that are exogenously given by a parameter psi. Yeah, and so psi changes from period to period. Important is that deposit outflow and deposit inflow is going to affect the bank's reserves. Yeah, so the bank goes into the period with these reserve holdings, incurs then a shock to the deposit base. Withdrawals and inflows of deposits have to be settled using reserves in a particular kind of ratio that is drawn from your paper. And you see here that importantly, bank efficiency shows up again in this ratio. You see in the numerator, you see the interest rate paid on deposits, and in the denominator, interest rate on reserves. So their efficiency shows up again. Overall, you have in the first term here changes in actual reserves, and in the latter term, you have changes in required reserves due to the shock. Yeah? So overall, what this means is that bank efficiency impacts the surplus or deficit in reserves. Yeah? So this is the second point where the efficiency parameter enters. Okay. Now, after the shock, banks have excess reserves or a deficit, which means they can access the interbank market or want to access the interbank market to lend or borrow. Alternatively, they go to the lender of last resort. But again, the focal point of the paper is on the interbank market. So let's have a look here. Okay, so the interbank market works the following way. Banks that have excess reserves go to the one side of the market. Banks that have a deficit go to the other side of the market. The market sides can differ because the shocks and the deltas are therefore highly heterogeneous. Yeah, so if we look at this picture that I've made, think of it as very similar to a limit order book. Banks are ordered by their efficiency. The most efficient borrower is on the top. The most efficient lenders on the other side of the market. And the matching algorithm starts with the demand side. So the highest ranked borrower, ranked by the exogenous parameter efficiency, proposes first and can ask the highest ranked lender to lend reserves. Okay? Now, this is the way that the matching, you have the ordering of the sides by the efficiency. Now, there are two types of costs that apply in the interbank market. The first cost is that if you are a borrower in the interbank market, you pay the interest rate RI on the amount of funds that you borrow, but there's also a variable cost. And this variable cost, again, depends on the efficiency of the bank, namely on the ranking of the borrower, which is me, and the lender, which can be you. Yeah, so the ranking of the borrower and the lender in this table here matters for your variable cost. The more efficient you are, the smaller your costs. And so what you in particular want to be is you want to be matched to a counterparty that's as efficiently ranked as possible. Okay. There's a second kind of cost, or a fixed cost, which means that the lending or the amount of reserves that are lent or borrowed needs to be above a certain number. Okay. But okay, and so you can always access or you can always borrow from the lender of last resort. There are no variable costs involved, but you borrow at a higher interest rate. And essentially, the banks face a trade-off between what are my variable costs if I go to the interbank market versus what's the interest rate if I go to the lender of last resort. Yeah, and so from the lender's perspective, there's a similar problem, but I will explain it from the borrower just to be a bit quicker here. Okay, so let me walk you through an example which I think helps understanding the matching algorithm. Okay, so you're the first ranked borrower on the top right. You can now propose to the highest lender on the left-hand side, and you see already there's an issue because the highest ranked lender has an excess supply of reserves that is below the fixed cost. Okay, so the first ranked lender is not interesting to the first ranked borrower. So the first ranked borrower then approaches the second ranked lender. Second ranked lender has a supply of 3 units of reserves, and so the first ranked borrower has a demand of 5 units. So indeed, borrowing and lending happens, and the second ranked lender is therefore completely depleted with regard to reserves. And the borrower has excess demand, 5 minus 3 is 2, therefore approaches the third ranked lender, and so on. Okay. Technically now, the first ranked borrower has no additional demand. Yeah, so we would go down the line and look at the second ranked borrower and third ranked and so on. Now the second ranked borrower in the example here will not go in the interbank market because demand is too low below the fixed cost, so will then essentially borrow from the lender of last resort. And you see that the third and fourth ranked borrowers, they are crowded out because the supply side is already depleted. Okay? Now, this is an example where we have not looked at the fixed cost yet. Yeah, this is just to give you an idea how the matching works. Now let's introduce fixed cost. Again, remember for the fixed cost, the ranking matters. So the first ranked borrower would like to would like to borrow from the first ranked lender. Now, how do the fixed costs come into play? This is the borrowing cost in the interbank market. These are the costs when borrowing from the lender of last resort, which means essentially you are looking for the minimum of this linear function and the variable cost function here. Okay? If I'm the highest ranked borrower matched with the highest ranked lender, this is my variable cost function here. Yeah, so it's my rank times the rank of the lender is 1 times 1. It's just Q squared. So this is the variable cost function that you see here. And it intersects with the linear function, which means I never want to borrow more than Q1 star from the first ranked lender, because otherwise I would rather go to the lender of last resort. What if I have excess demand beyond Q1 star? Well, I would need to approach the second ranked lender. But the second ranked lender has a different cost function, and the third ranked lender as well. So I would want to borrow less and less and less. Okay? Now remember, it's a matching market. The lenders, the first ranked lender and so on, go through a similar problem, and only if they, so you would essentially always want to coordinate on the minimum amount at which both are willing to lend respectively borrow. Okay, so I think this sums up what's going on in the matching market the way I understand it, and now let me come to my comments in the last 4 minutes. Okay, so I think the first comment is the efficiency parameter scales multiple things in the model and therefore impacts also the simulation in various ways. And I think it makes sense to reduce the impact of the efficiency parameter. In particular, I think it makes sense to focus truly on the novel part in the paper, which is the matching algorithm. So maintain the impact of kappa on the matching priority and the costs, but I would take out the impact on the deposit rate and therefore also here on the settlement of reserves. Because if you take it out, it allows you to cleaner see how your efficiency parameter affects the results. That's just, I think there's too much happening here with the kappa parameter. The second comment also aims at the kappa parameter and is a little bit more involved, and so I usually try to not tell someone what to do in the paper, but so I have a suggestion here. The variable cost in the matching market is really reduced form. You already pointed it out, but the efficiency here of a bank really it drives the result that a more efficient bank becomes larger. It directly drives the result because you're more efficient in the interbank market. You have better deals in the interbank market, you become larger, and this accumulates simply over time. And so the question is it possible to microfound somehow what this efficiency parameter kappa actually means? Yeah, and so efficiency is tricky because efficiency is usually an outcome. It's not an assumption on a bank. So, and I think there's a very natural way to build a microfoundation for your kappa parameter and also for the variable cost function. So this is what I think would be interesting. So what if kappa is not the efficiency of the bank, but it's an arrival time in the interbank market? It's a stochastic arrival time. And banks arrive sequentially, ordered by whether they are a borrower or a lender. It's very similar to your matching algorithm, to your limit order book. Now, these sequential arrivals have been studied in previous papers by Wallace and by Green and Lin, but in the context of depositor runs on banks. But here you have a similar thing going on, namely, if I'm early in the interbank market, I have match priority. So I call this, where is it? First come, first match. If you arrive early in the interbank market, you have the right to be matched first. What's the cost? Well, there's a very natural cost that comes with it. You have to wait. You have to wait around for a counterparty to arrive. Now, assume that you are the highest ranking borrower here. then you arrive early, you have to wait for your lender. And while you're waiting around, you incur a cost, okay? And so the cost scales with the random arrival. And even as the first lender finally arrives and you get matched and land from that guy, maybe you have excess demand. You have to wait longer until the next lender arrives, and you have a higher waiting cost. It's very similar to what you have in your model. Now, there's a slight difference because if you look at these distances here, so distances are different from products, yeah? Because with distances, it's the case that you actually want to arrive very close to when others arrive. Then your costs are small. Yeah, so this is the difference. But if you have a first come, first match constraint, there's a huge advantage to be early. You have to wait around longer, but you can be matched first, which means that here, if you're the first borrower, and then the second borrower arrives, the second borrower will have to wait until the demand of the first ranked borrower is fully depleted. Yeah, so this is, I think, a way you can do it. Okay, so let me wrap up. I think the idea is very interesting to look at this matching market. I would again reduce the impact of kappa, and I would look for a micro foundation of the cost function. And I think that's doable. Okay, thank you so much.
Thank you. We have 4 minutes. Questions or you want to take 2 minutes to reply? Yeah. And if you have questions, please use the microphone.
Yeah. Thank you, Linda, for an amazing discussion. Thank you. Your example, the figure that you plotted is super illustrative, and the micro foundation idea is great. So that's something that we have been thinking of. We didn't know how to do it. Yeah, we haven't been able to crack how to microfound the assumption that we need. But I think the first come first match idea is brilliant. So that's something we'll definitely add to the draft. Yeah, I have nothing to add.
Hi, I have a quick question regarding this with respect to the interpretation of the kappa. Before you think about how to microfound it, how do you interpret it? Because to me, what it kind of sounds like is a little bit like netting interbank obligations among themselves. So banks, through the payment systems, they endogenously generate money because they net obligations that they have one towards the other. So is that one way to think about kappa, that the larger banks might want to trade with other large banks because they're going to have the largest gain from netting interbank obligations and therefore having to settle on the payment system the smallest amount in central bank money? Is that how you want to think about that? And therefore, the related question is, what do you see in the data about these trades, these interbank trades? What are the data on it? Because then that might tell you about whether it is the originating loan or the amount of central bank money that moves in the payment system. I'm not sure if I was clear.
Take more questions if there are, and then I'll answer.
So very quickly, so I was thinking of Chari's question, and so you have this number of shocks which are not that large in your model, but then isn't the central bank absorbing whatever is left through, because in the end of the day, if there is some, you have these shocks, if they don't add up to zero, which they won't because you don't have the law of large numbers, but then whatever is left is absorbed by the central bank. So isn't it the central bank taking care of that?
Yes, so what is the...
There's one
more. Okay.
Trying to understand conceptually how to think about this paper. Sort of, there's an inefficiency result, and there is a market structure that's described by this algorithm that's leading to this inefficiency. But we can write down lots of algorithms and market structures that would lead to inefficiencies. So is there some evidence or some way of thinking about this is the market structure that we're seeing in the world and therefore we should think about interventions to correct the inefficiencies that are caused by the market structure the researcher has written down.
I'm not adding on to the list of questions, but if you could spend just a minute elaborating on what the source of the inefficiency is, what's the sense in which the equilibrium is inefficient, that would also help.
Yes, thank you very much. So lots to think about. So let me just address these questions. So what is kappa? So you could think of them as, so I had a sort of a macro view of it. So what you suggested is also, I think, is perfectly fine. My motivation also in the paper is that banks differ in monitoring efficiency. So you can think of the first generation of work by Diamond, also Stiglitz and Weiss, what they coin as monitoring devices. So some banks are just better at understanding counterparty risk, for example, and that's reflected in kappa. In Linda's formulation, that would be because they're better, they're also always arrive earlier in the market. So that there could be potentially a link there for sure. The second question on central bank absorbing, I see that now. So where I'm probably missing for sure some final market clearing equation, so that we need to make sure that any excess or liquidity is always settled. So there's definitely, because we have a discrete number of banks and that number is small, the central limit issue needs to be dealt with. We will deal with it. And finally, so uniqueness. So we don't claim uniqueness. So that I don't think we cannot. So we know for sure that certain types of algorithm, like a standard basic valuation of algorithm, cannot work. So we know sort of which algorithm will not work, but we don't know the full set of algorithms that do. So ours is just one of many potentially that will work. I agree that if you come up with a different algorithm that matches the sort of sorting thing that we see, potentially the inefficiency might not be there. I agree. So.
All right, thank you. Take a break. Oh, okay. We're gonna have the second paper. It's gonna be on bankruptcy exception of repo markets. Too much today for too little tomorrow. The presenter is Viral Acharya. And a reminder, if you have a question, if you can please get the mic so that people that are following online can see that.
Great. Thank you to the organizers for inviting us to present. This is joint work with Ravi Anshuman, who is at IIM, Indian Institute of Management, Bangalore, and Vish Vishwanathan, who is at Duke. Repo markets are considered quite important in the financial sector. Work by Adrian and Shin shows that large broker-dealer and other kind of intermediary balance sheets grow on the back of raising secured financing in rollover claims, which are often called a sale and repurchase agreement. Technically, it's not a borrowing transaction. It's actually, legally, it's a sale of the asset, and then the borrower agrees to repurchase it. And if they don't repurchase the asset, then in some sense, you can call it a default on the transaction, so to speak. The asset then stays with the financier in that case. But typically, they tend to be short-term contracts, and you can see that in the slide below on the left from Adrian and Shin. You can see there was a huge growth in this market, but prior to the global financial crisis, and a lot of that growth was actually in the overnight market, but then there was also a sort of a sharp collapse in this market in the rollover financing as well. These are large markets. Typically, they are against treasuries and mortgage-backed securities. And I want to stress this, which is that these markets are typically against what one might consider as relatively safe collateral. These are not markets for sort of very extreme opaque assets, and something that will be important later in the presentation. And one thing that's interesting is that while the 07-08 episode was more about mortgage-backed securities, repo, especially bilateral repo getting stressed, recently a very nice paper by Copeland, Duffy, and Yang seems to show that these kind of stresses have now started entering the treasury repo markets as well. There are many causes which are attributed to these spikes. But notably at the time of COVID outbreak, there were hedge funds that were taken leveraged positions in the treasuries markets, and then they had to engage in liquidations of these positions that seemed to actually create a risk of spillovers to other markets. Now, one important aspect of the repo markets over the last, I would say, close to 4 decades is that progressively the legal treatment of these claims in bankruptcy of the borrower has been made more and more favorable to the financiers or the creditors. And these are called as safe harbors, which is that if a broker-dealer files for bankruptcy, the repo financier has a safe harbor, which is that there's no automatic stay on their claims in bankruptcy. They can just take the collateral, walk away with it, and liquidate the collateral in the markets that they want. Okay, so it's sort of like a design. So the safe harbor for repo financing is like design of the creditor right in bankruptcy, that you can actually liquidate the collateral, whereas if you had automatic stay, you could not actually seize your collateral for a certain number of days in bankruptcy. So in corporate bankruptcy, there's an automatic stay on secured creditor rights. But in financial bankruptcies, specific repo claims, especially on treasuries and then progressively on mortgage-backed securities, have been given these kind of exemption. So what that means is these claims can then be settled with immediacy. Financiers can exercise their property rights over the underlying collateral. And because a lot of repo financing comes from money market funds that are lending short against long-term assets, rules actually don't even allow them to own these assets. They have no choice but to actually liquidate these assets right away because they would otherwise violate their average maturity restrictions from this Securities Exchange Council. So there's a whole history of these granting of safe harbor provisions. It started with treasuries and government-sponsored enterprise, Fannie Freddie agency securities. Then prior to 2005, it was also extended to non-agency, so private label mortgage-backed securities. And generally in the literature, they are thought to increase ex-ante lending, just like the sort of the work in law and finance that you give secured creditors stronger rights, it will lead to creation of greater credit against the underlying assets. But a range of recent papers also seems to suggest that this higher leverage and extra entry that you are getting from the provision of these safe harbors may have some downside associated with it because it can also lead to exposed fire sales. So take the example of COVID that I was giving. Hedge funds can lever up against treasuries quite a bit, but then if they engage in fire sales, even though the underlying collateral per se is a safe collateral, the fact that it's funded with so much leverage can lead to a great demand for immediacy for liquidity in the system. Okay? So what we are trying to do in this paper is to kind of have a model in which both of these effects are there and then highlight that actually for reasonable sort of cases in which you would think we are talking about the safe harbor provision like treasuries, MBS markets, etc., it's not at all clear that you want to grant these safe harbor provisions, that it might just have a lot of exposed consequences without too much ex-ante benefits. Yes?
So, Viral, I thought there was a literature also which dealt with something else which is not on this slide, which is other kinds of debt that you might raise, which don't have access to the safe harbor provision, might get crowded out as a consequence of this. Are you going to say anything about that, or this is mainly about fire sales?
Yeah, we're just going to focus on this contract only, yeah, I think there's a nice literature on crowding out of unsecured debt and what that might do. I think Enrico Perotti and co-authors have some work. We are not going to touch on that at all, but I agree it's an interesting question in the capital structure of these firms. Yeah. Okay, so the main argument is the following. So we think that this idea that you should grant secured creditors stronger control rights is basically a partial equilibrium argument that, yeah, they will get more payoff in bankruptcy, so then it will cheapen debt cost all else equal, so it'll increase leverage and maybe that'll lead to origination of more assets ex ante. But once you entertain this possibility of fire sales, which may be a big consideration for financial assets, and especially given the way repo is financed, which is by money market funds, the general equilibrium spillover is going to be that the buildup of leverage will lead to fire sales. Fire sales will mean that there are huge returns to financial arbitrage. So those who are surplus liquidity at the time of some shocks that lead to these deleveraging will now say, rather than making loans to the real economy, why don't we just go and do financial arbitrage? Okay, so there'll have to be a cross-market arbitrage between loans to the real economy with, and of course, I'm just saying loans to the real economy, but it could be any other kind of intermediation function. The returns on that will have to match the returns on financial arbitrage in the economy. And then that's going to have a huge exposed cost. And what's interesting is that the more you have facilitated higher leverage up front, the more severe is going to be the exposed problem. So precisely when you think that the ex-ante benefits might be greater because you are allowing leveraged entities to come in, et cetera, is when actually the exposed problem is also going to be much, much more severe. Okay? So in our model, the interesting effect is that this general equilibrium effect most of the times actually will dominate the partial equilibrium effect. Okay? The fact that exposed, you will be crowding out in the bad states of the world intermediation functions because there's a fire sale in the repo market, that's actually going to dominate the benefit ex ante, if any, of actually creating a greater entry into the financial sector. Okay? And one crucial assumption we make, which I'm beginning to like a lot, even though it might seem a bit extraordinary from traditional modeling standpoint, is that we're going to assume that as there is more entry into a sector, in this case the financial sector, the marginal dollar that comes in is more and more leveraged. Okay, so one way of thinking about it is that it's sort of like a diminishing returns to scale, but we are going to do it not through same investment, but diminishing returns on cash flows. We are going to say same cash flows, but diminishing returns because it has to be funded with greater and greater leverage. Because we think in financial sector, it's not that treasuries' cash flows are diminishing returns to scale, it's really that the marginal entry in the treasuries' positions is more and more leveraged in the economy, like hedge funds, for example. Okay, so in interest of time, let me not get to the result right away. But so a very self-critical take on this paper would be that there was no need to write this paper, okay? So that, if you just take the insights of Lorenzoni and Jeremy Stein's QJ 2012 paper, Lorenzoni's Inefficient Credit Booms paper, that really the insight is there, okay, which is that you can create excess leverage, there's some incompleteness in the market through which there's going to be pecuniary externalities, so you have to restrict leverage up front, okay, and that's it. We don't need to write this paper anymore. But I think what we have done is maybe written a model that's closer to the specific setting of the repo contracts, at least in some dimensions, not all. And I think we are going to focus on, so a lot of this literature then basically focused on saying, why don't we restrict leverage up front? We are going to focus on saying, let's look at these credit contracts in the first place. Maybe we have given them too strong control rights to liquidate the underlying collateral, and let's then think about optimal design of the creditor contract itself, rather than saying, let's take the safe harbors as given and then try to unwind them by actually restricting leverage in the economy upfront. So maybe that's interesting, but I think I learned some new things while writing the model. Hopefully I can clarify some of these things. It relates a lot to Eduardo's very nice paper with Anton Korinek and then the follow-up paper by Lanteri and Rampini, which is that in our model, these distributive externalities are going to be very large, which is that when the fire sales occur, there's going to be this crowding out effects in the real economy. Doug and Raghu have a very nice paper after the financial crisis also trying to explain how these kinds of cross-market contagions can happen. And then that's going to also in our model affect endogenously the asset quality, as I'll try and explain. And so the safe harbors, maybe the right way to think about them is not to just think about whether it increases debt capacity. It's best to think about them as what they will lead to for the economy when aggregate stress materializes. Okay, so let me try setting up the model. So it's a 2-period, 3-date world, 0, 1, and 2. There's a continuum of financial firms with differing amounts of investment shortfall. So everyone has the same unit of asset, but they need to be financed with differing shortfalls. One way of thinking about this is what I was saying, that there is increasing leverage on the marginal dollar that comes in. Another way of saying it is that some of the marginal dollars and entrants in the financial sector are not as efficient, not as productive, so they need to raise more financing to hold the same asset on their balance sheet. There are 2 types of assets in the economy. Literally, they are just date 0 and date 1 assets, but I'm going to call them financial assets. They're going to look more like treasuries or mortgage-backed securities against which you can do repo financing. And then there are non-pledgeable or non-collateralizable assets at date 1. I'm going to call them assets to the real economy. Think of them as small business loans if you want. They cannot be pledged to raise capital due to asset specificity, complete illiquidity, etc. And the key dimension is going to be whether repo financing getting safe harbor is creating too much financialization of the economy at date 0 with too much of a crowding out of small business loans, etc. at date 1 in the economy. Okay. So the structure is the following. So these financial assets, they have some uncertainty about them. There's a state of the world theta that's going to be an aggregate risk. It's going to be realized with some uncertainty. So theta can be high or low later on. But right now, just think about theta as the quality of that financial assets that use for repo financing. With some likelihood, it will yield a high return. Otherwise, there's a small chance that it may give nothing. These loans to small businesses, they are sensitive to the rate at which you lend to them. If you lend to them at a very high rate FR, then endogenously the quality of the loan will get affected through some effort exertion by the borrowers in that real side of the economy. So the intermediaries at date 0 are going to invest in these financial assets. They'll do so with repo financing. It's going to be short term. It has to mature at date 1 and then get rolled over at date 2. There's a way of microfounding the short-termism of this debt. And then we are really then asking the question, how can we microfound this bankruptcy parameter, as I'll explain. Okay? Then there's going to be this aggregate shock theta that's going to materialize at date 1 minus. So you get some signal about the state of the economy. That's going to be just before date 1. And that's going to affect the rollover capacity of the underlying repo collateral at date 1. Okay? And simultaneously, there's going to be a demand for loans from the real economy at that date. So the financial assets are going to go in the secondary markets at some price P. The new loans that are made are at some face value FR, and there's going to be some quantity of loans beta that's going to be made to the real economy, and those are the 3 key parameters. What's the price of the financial assets? That's going to determine how much fire sale discount there might be. At what interest rate are new loans going to be made? There's going to be a cross-market arbitrage that's going to discipline the 2 of them together. But there might also be rationing, and therefore we have to also keep track of the size of that intermediation to the real economy beta at that point. Okay, and as I explained, once these loans are made, there may be some possible asset quality which is endogenous because of efforts of these small entrepreneurs. Yeah.
So for the financial assets, are you thinking of treasuries or something riskier?
It could be treasuries, I think mortgage-backed securities probably fits it the best because there's a small chance of not going in. But I'm from an emerging market. I think all government securities have a state of zero attached to them as well. It may be very small probability, but I think that's true for the US. We have seen it for the UK. So there's some probability that there can be a fiscal scenario, some state of the world that materializes. Maybe I shouldn't be saying this in a Federal Reserve, but I don't know.
You can.
Okay. Okay, so the key point is that there is this bankruptcy exemption parameter, which is that at date 1, there will be a set of borrowers based on their leverage at date 0 who will not be able to roll over their claims at date 1. It's going to be a function of their leverage. It's going to be a function of the realization of this variable theta. And actually, it's going to be a function of the entire distribution of leverage in the economy because that's going to determine surplus liquidity out there. So we're going to assume that when someone defaults on their repo contract, with probability Q, the money markets can take over the collateral and liquidate it in the secondary markets themselves. Okay? We're going to assume this Q, for simplicity, is idiosyncratic across intermediaries. So basically, in the aggregate, a proportion Q of the defaulted firm's collateral is going to get liquidated. What happens to the 1 minus Q? They are subject to the automatic stay, and they are going to then get a lower payoff, which is just the financing capacity of the asset at that point. Okay, so the model is solved in 3 stages. First, I have to show you what all happens at date 1. Then I have to solve the leverage choices at date 0. And that's going to endogenize the entire leverage distribution in the economy. And then I have to calculate how much surplus is getting created as a function of entry into the financial sector at date 0 and the quantity of intermediation that occurs in the economy in terms of loans to the real economy at date 1. And then how does all of that get affected by this parameter Q, which is the bankruptcy probability? Okay, so that's the exercise. Yes.
Just a quick question. Why do you need moral hazard in the loans to real economy?
Yeah, so you'll see that it's probably not entirely necessary. We could just kill that piece if we wanted. You'll see that there's a little bit of micro part of this arbitrage that I find interesting, which is that when the fire sales just start, initially there's no quantity rationing to the real economy. It's going to just show up as tightening of rates. And that itself is going to hurt welfare through the endogenous asset quality impact because higher rates are going to mean poorer effort exertion by the entrepreneurs. Then you will get rationing, quantity rationing at some point. And if you want, you can just focus on that region by saying, listen, the rates are always at the monopolistic rate of each bank. So there's nothing to adjust on the rate dimension and everything happens just through quantity. I don't know, maybe I agree, it's detailed, and I think I was thinking last night that maybe there's a simpler way to deliver the model, but yeah. Okay, so let's first go through lenders' decision to roll over the debt at date 1. So in my original paper with Vish, we model a risk shifting problem, which is that there's some risk management required on this underlying book of financial assets, and leveraged intermediaries can basically swing for the fences. Your interim date 1 creditors recognize that if the theta shock is not very good, the quality of the asset has deteriorated, net worth is not very high, and you may gamble for resurrection. So they reduce the refinancing capacity of the asset at that point. But net-net, what it turns out to is that you can simply say that the funding capacity of the asset is rho star, which is equal to theta y, which is the expected cash flow on the asset, minus an illiquidity discount. Okay? You can micro-found that illiquidity discount through a debt overhang problem, a risk-shifting problem, whichever way you like. But what we are going to assume is that there is some discount K in the refinancing capacity of the asset at date 1. So, okay, so basically, a part of your assets become non-pledgeable because of an agency problem of the borrower at date 1. The key is that it manifests when theta becomes low because it's low net worth intermediaries who engage in possible gambling for resurrection. Of course, in the model, that's all off equilibrium. Okay. Households, everything is very standard here. Maybe it's not so crucial, so I'll just go through it quickly. The underlying asset yields some return R. The small businesses or the households have some cost in order to run these assets, which is quadratic. They borrow at a rate FR, so they're going to pick an effort E that's a function of their borrowing rate. And then, that's given by this function. And then there's this endogenous asset quality link from the tightening of financial conditions to the quality of the real assets in the economy. Okay. Now, so this interest rate in the model, the way it's written now, plays an important role, which is that if banks could just charge monopolistic interest rates on the loans that are borrowing from then they would just maximize E times FR, and then they would set the interest rate at R over 2 under these assumptions. Okay? But if there's a competition in the lending market, actually the EFR, which is the expected value of the repayment on the loan times the loan amount, the loan repayment amount, that has to be 1 to meet the individual rationality of the lenders. Okay, and so the competitive interest rate, FR, is going to be lower, of course, than the monopolistic interest rate. But as funding conditions tighten, you're going to traverse this path from the competitive rate to the monopolistic rate, okay? Because effectively, if there's an aggregate liquidity constraint, everyone effectively gets a right to basically pass on their costs into the lending markets at that point, okay? Okay. Now, let's look at the liquidation decision of constrained firms. So I'm going to denote the face value of repayment in the capital structure at date 0 of an intermediary as rho. And you can just rank the intermediaries by their leverage. So some of them have rho equal to 0, say it's all equity finance. And some of them have rho which is very high, which is that they need a lot of financing in order to set up their firm. Now, rho star is the funding capacity of the asset in the rollover market, which was that theta y minus k term. So firms which have a leverage need to repay at date 1, which is greater than the funding capacity of the asset, are the ones who potentially have a rollover risk problem. Okay? Now, what can they do? They can file for bankruptcy if they want, but before doing so, they would like to potentially just scale down. They'll deleverage because there's a secondary market for the underlying collateral, so they can sell the assets in the market at some price P. Typically, the price P will always be greater than that amount of funding capacity rho star, because anyone can take the asset and raise rho star in the market. Okay, and so rho star is a cap on the secondary, is a floor on the secondary price of the asset. Okay, so there's a set of intermediaries with a leverage greater than rho star up to some upper bound rho upper bar who will be engaging in deleveraging. They will be scaling down their balance sheets because the funding capacity of the asset has gone down. They'll sell some assets at a price which is above the funding capacity so that they can operate at a lower scale in the market at that point. But intermediaries who have a leverage which is so high that even by selling all your assets in the market, you can't raise enough new financing between asset sales and new funding to pay off your old leverage, they will be bankrupt. And then with probability Q, all their assets will be sold by the money market funds who take over the assets because they are allowed to do so. Okay? So there's a supply for sales of assets in the secondary market, which is a function, which is the integral of all the leveraged intermediaries from rho star, the funding capacity of the asset up to some upper bar, and of defaulted intermediaries, a proportion Q of which will get sold in the market. Okay, so, and then how does the market clear? There's a set of intermediaries who have taken on leverage at date 0, which is lower than the funding capacity of the asset rho star. They are surplus liquidity. Okay, they can meet their rho star, the rollover need, and they can actually raise more in the market. So they will be supplying liquidity to the market. In fact, they are the only ones who can also lend to the real loans market. So they have to solve a portfolio problem, which is how much to allocate of their liquidity to the secondary market for the financial asset, how many new loans to make out there. Okay, they will take the face value on the loans as given. It's a competitive market. but when funding is tight in the aggregate, in spite of it being a competitive market, the lending rate will be higher than the unconstrained competitive rate. Okay? What's the budget constraint on their liquidity? If they buy new assets alpha, they can already raise rho star of that in the refinancing market, so they have to only finance P minus rho star from their original balance sheet. They are funding beta of the real loans. Those are not pledgeable, so they have to raise entire of that beta from their balance sheet, and that has to come from the available liquidity, which is rho star minus rho, because they are not very leveraged, so they have some surplus liquidity on their balance sheet. Okay. So then comes the cross-market arbitrage condition. So as I mentioned, this is there in the work of Gromb and Vianos, Diamond and Rajan, and so on. But basically, this condition looks like following, which is that the financial and the real asset markets have to be basically joined at the hip, okay? Because otherwise, intermediaries will just allocate all their liquidity to one versus the other. So when both markets are open, on a unit of asset purchase, the financial intermediaries make the fire sale, which is K, which is the non-pledgeable part of the cash flow. And how much does it cost them to finance it? It's P, which is the secondary price of the asset minus the funding capacity of the asset. Okay? So on each dollar of investment in the financial arbitrage, they make K over P minus rho star. What do they get if they do real loans? They get EFR, which is the expected repayment on the loan. So as long as the market is open, this arbitrage condition has to hold between the two markets. So what's going to happen in the equilibrium of the model that's interesting is that to start with, even if there are fire sales, the market is going to be meeting, the intermediation sector will meet the full demand of loans in the market, okay? So there's some upper capacity of demand from the real sector, and the intermediaries will meet that, but as soon as there are fire sales, they will start tightening the financing conditions by raising the loan rates to the economy. So, like just think of this as senior loan officer survey telling you that, banks are passing on costs because their rollover conditions are tight, okay? Then, at some point, and this is where the rate starts playing a role, as the competitive rate starts getting closer to the monopolistic rate on the bank loan, at some point you can't increase the loan rate any further because you're going to actually deteriorate your payoff. The loan rate is so high that small businesses are not going to run their businesses well at all. At that point, there is no point increasing the rate. You start now channeling liquidity from the real economy into the financial arbitrage. Okay? So there's going to be a region in which the quantity of loans to the real economy is going to be fully met, but it's the loan rate that's going to illustrate the tightening of financial condition, and then it's the loan rate that's going to then simultaneously also pin down the price. And then there's a region in which the loan rate is now fixed because you can't charge more than, say, 15% to a small business, because beyond that it's a value destroying for the bank itself. And then banks say, okay, now let's just do credit rationing. I'm not going to lend enough to the small business sector because I need to allocate funds to the financial arbitrage. Now, at some point, as the money starts going more and more into the financial sector, and how is that going to play out? That's going to be a comparative static on this theta. The lower is theta, the lower is the funding capacity of the asset. The more and more funds have to go into the financial market, at some point you get a complete credit crunch, and the real sector is just crowded out altogether. All money goes into the financial market at that point. Okay, so you can solve for the market clearing condition. There's a surplus liquidity on the balance sheet of intermediaries whose leverage is from rho min up to the funding capacity of the underlying assets. There's a demand for financial arbitrage. There's a demand for, let's call it, real arbitrage. The sum of the two has to be met by the surplus liquidity condition, and that pins down the price of the asset, which is always equal to the funding liquidity of the asset plus how much cash there is in the market, how much aggregate liquidity there is in the market. Okay, so this is like an Allen and Gale kind of cash in the market pricing condition. It says that the market price, which is the market price of the asset, is the funding liquidity of the asset plus whatever is the demand for buying these assets from surplus intermediaries. Okay. Now, as you can see, it depends upon how much of the surplus liquidity is going to the real economy. Okay, so the price of the financial asset depends upon aggregate surplus liquidity, but how much of that is going away into making loans to the real economy. So if this is full, so you satiate the real market for loans, that pins down the price, and then that price pins down the loan rate. Okay? Conversely, if you go back, if you are in the region where you have hit the highest rate that you can charge on the real sector loans, then this cross-market arbitrage condition is going to pin down the price. And then now you go to the market clearing condition, you have the price which has to equal the loan rate, which is the highest loan rate you can charge, and that's then going to pin down the quantity of loans that can be made to the real economy. Okay, so this is the way you first get higher interest rates and endogenous asset quality reduction, and then you get a constant fire sale discount in prices, but that implies that basically the flow of money has to go from the real economy to the financial economy. Okay, so you know, you can sort of formally characterize all this. There's a fair pricing region when the theta shock is not so bad. If it's an intermediate theta shock, you end up in first where the loan rates are changed, then the quantities decline, and then there's a complete credit crunch or a big recession out there in the economy. Now, just the way theta moves these things around, the bankruptcy exemption parameter Q is also going to actually cause a movement of the economy across these regions. Okay, so the intuition is that the more you provide Q, which is the bankruptcy right to the creditors, the more you are likely to be in these stressed regions. Okay, so then now we need to solve the structure back at date 0. So now we introduce aggregate risk, which is that this theta, which is the quality of the underlying asset, can be high or low. We assume that when the quality of the assets is high, there are no frictions for simplicity, no rollover friction in the repo market, no moral hazard on the small businesses. However, with some likelihood 1 minus R, you can be in a low or an adverse state of the world, and now there is a discount K in the financial repo rollover market. Now the key point is that, let's say that the initial potential intermediaries have shortfalls which are distributed over some support S min to S max. Okay? Now what is the maximum shortfall that can be financed? That's a function of what price can creditors receive against their assets in bankruptcy. So the highest payoff in the high state is theta h YH that can be promised. So you can promise YH and get this as a repayment. In the states, in the stress scenario of the world, there's going to be fire sales, and there's a price P bar that the money markets will expect from this, which is going to be a function of Q, because the probability Q, they can liquidate the collateral, otherwise they can't. So that pins down what is the highest shortfall that can be funded in the economy, and implicitly it says that the money market funds are deciding how leveraged an entity can be allowed to enter into the financial sector at date 0. So as you vary Q, as you vary this aggregate risk, you are actually rationing entry into the financial sector at date 0 by chopping off the leverage at a cutoff S hat. Okay? Now, why is this important? Because the traditional partial equilibrium logic is that if you increase Q, you will increase P bar, and that way you will allow greater entry into the economy by funding more shortfalls. Now, the way we have modeled these shortfalls, because of this diminishing returns to scale via larger and larger investments, this is going to imply also higher leverage. That is then in turn going to affect the price P bar that you can get in the first place. Because if leverage is very high, more people will be demanding liquidations in the economy. Okay? So what's interesting in the model is that the distribution of leverage at date 0 is endogenous to all these parameters and endogenous as an industry equilibrium, as in the work of Schleifer-Wishny, for example. Okay, so I think none of this is terribly important. So we have to truncate the support of the distribution, not over the full distribution of original shortfalls, but only to those leveraged intermediaries who can enter the economy at date 0. Okay? And then you get the main result. You can calculate the surplus on the loans at date 1. So that's the loan per household or small business. at date 1 in the high state, you fund the economy fully and generate capital R without any asset deterioration. But with probability 1 minus R, there might be rationing. There might be an endogenous asset quality impact on the small business loans, and all that has to be calculated. At date 0, you are funding all these intermediaries from S-min to an upper bound S hat of shortfalls, and they are generating theta y minus S. The sum of these is the overall welfare, and you can calculate the outcome. Okay, so let me just illustrate first state the proposition. So what we can show is that if the funding illiquidity of the asset K is not very large, then there is already very high leverage in the economy. So a property of treasuries and mortgage-backed securities is that these bad states are not expected a priori with very high likelihood. So there's already a lot of leverage in the economy against these assets. Then the result is that you never want to choose a Q that puts you beyond the fair pricing region. Okay? You want to choose a creditor right for repo financiers with knowledge of all the other parameters that never moves you into the fire sale region at all. And that's because the result is the following, which is that you have this region in which first the rates rise, here the quantities get constrained, here the market shuts down entirely. This happens as you increase the safe harbor provisions to become stronger and stronger. And you can see that there's already a lot of leverage in the economy at date 0, which is plotted on the top. There's a small increase in the leverage in the rationing region, but that's more than offset by these liquidations, because that small entry of players that is happening at date 0 is actually the highest leverage intermediary of the economy. So they're going to contribute tremendously at date 1 to this fire sale pressure, and as a result of that, this distributive externality over here completely offsets the partial equilibrium style intuition that you're going to get more entry out there. You can reverse this result, but to do that, you need to assume the asset is so illiquid that there is almost no leverage against this asset at date 0. Okay, so it's almost like the asset is so financially constrained that you would like to give a safe harbor. But we think that's not the policy problem at all. We are talking about safe harbors against treasuries, mortgage-backed securities, etc., which are very, very high liquid collateral to start with. Okay? So the main result is that as the magnitude of the economic shock, let's say theta L becomes high, the aggregate shock, or the collateral becomes very illiquid in that state of the world only, then you want to choose a bankruptcy parameter which is exactly at the boundary of the fair pricing and the fire sale region. And in general, that means you don't want to give a complete safe harbor to the repo markets. Okay, I think I'm sort of out of time. Just one last result, if I could just mention. So you can then ask the question, oh, why go about things in this complex way? Why don't you set a capital requirement? Why don't you restrict leverage at date 0 the way all these fire sale externalities model work? So it turns out that because the optimal choice of, so this might be of theoretical interest, but I think there's some intuition that is useful here, which is that it says if you don't give too much creditor rights to immediacy, so suspend their conversion to immediacy with some likelihood, then you are always at the boundary of the fair pricing and the fire sale region. But once you are at that boundary, no fire sales take place anyways. There's no need to restrict leverage anymore. Okay, so it says that if you design your creditor contract in the right way, you actually don't need to use any capital constraints in this economy at all, because there are no fire sales in equilibrium in that case. Okay, so let me conclude. The paper's main contribution is to highlight that bankruptcy exemption of repo contracts can have these exposed distributive externalities which are very, very large. And in the model, it operates through two channels. One is, of course, there is this cross-market arbitrage, but it's also operating through this important assumption that there is the marginal entry into the financial sector is of the higher leveraged type. And that itself then contributes to the distributive externality being very large. So there is an impact on entry in the model along the standard intuition, but it's exactly of the wrong type. It's of the highest leverage type, and that's going to actually make the distributive externality very, very large. One final point, we have not looked at anything about lender of last resort, et cetera, in this model at all. My intuition is that what that's going to do is that it's going to create even more entry of leveraged intermediaries into the economy, and perhaps the result will still hold that the more you are likely to do lender of last resort, actually the stronger you need the automatic stay on all these claims, because you really then need to fight the leverage ex ante. Okay, thank you.
Thank you. The discussant is Eduardo Davila.
All right. Well, first of all, let me say this seems like a great initiative, and I'm really, really excited to be here in the first edition. And let me thank the organizers for giving me a chance to read carefully Viral's paper. So just for those of you who want to be reminded of, what is a repo contract? It's a very short-term collateralized credit. Okay, as Viral explained, it's a bit of an unusual way to do collateralized credit, because when you do a repo contract, what you do is if you have a financial asset, what you do is you transfer it to your lender, you get cash, and then tomorrow you commit to buy back. But for all economic, practical purposes, this is just collateralized credit. Okay, so if you find that confusing, just think of you're taking some credit that is secure by an asset. Okay, and this form of security is what's typically called a safe harbor provision, or here it's going to be called a bankruptcy exemption. I'll come back to this in a second, which means that your assets have no automatic stay. So if you go bankrupt, your creditors cannot seize those assets. It's only going to be this lender who gives you a secure credit who can take it. Okay, and in this case, typically what's going to happen is the lender is going to seize and sell, again, I'll also come back to this, collateral in the open market. So the question in this paper is, should repo have a safe harbor provision? Does it make sense? And in a sense, it's a quantitative question. It's how large this safe harbor provision could be. And the trade-off, as Viral explained to you, goes as follows. If you have a larger safe harbor provision, or if the lender can sort of recover more, there's going to be more liquidity ex ante, in the sense that there's going to be more funding available through standard pricing mechanisms. So the lenders recover more, so they offer better credit conditions, or credit is cheaper ex ante. And exposed, the key mechanism in the paper comes to these liquidations. Okay, so if you have this safe harbor provision, then if there's a bankruptcy, the lenders will have these assets, and then they will sell them, and then it's going to generate a kind of standard fire sale, and in the model, it's going to generate less investment down the road, because these other resources are not going to be used to investment, they're going to be used to buy these fire sale assets. Let me say, overall, I think it's a really, really important question. As you saw, it's a carefully crafted model. I enjoyed reading also Viral's earlier work on some of these issues, and I really captured some of the very first order trade-offs. So a high-level summary, as consistent with Viral said, is you solve the model in two parts. It's a simple, it's a three-period model, very basic. Date one, you're going to focus on how default takes place. You model the distress sale, and then you have this new loan origination. Then you go back to date zero. In Viral's model, investment is very simple. So it's really a borrowing or a leverage decision. And then sort of the meat of the paper occurs when you look at an ex ante welfare analysis exercise. Okay, so we're going to have one key parameter, Q, is this safe harbor parameter. And so I'm going to show you in a second, we're just going to move it. Okay, so in the real world right now, we have Q equals 1, so we have safe harbor. And the thought experiment, the counterfactual, is what if we move it from Q equals 1 to Q equals 0? What happens? Does welfare go up or down? Okay, and the way it's modeled is this probability of sort of not renegotiating. So in the model, once you default, if Q is 1, you sort of immediately renegotiate, and then there's no sale. And if Q is 0, then you have the sale right away. So that's sort of the way it's modeled. So I'm going to sprinkle a few remarks on all my slides. I love the smooth policy. I love the Q, because it's going to allow us to do things differentially. It's going to be very clear where the effects are. When I teach these things, I would say this is great. So smooth is great. Second, I'm going to come back a little bit about how we model this Q. Honestly, before I read the paper, I didn't think about this renegotiating probability. I thought about more like going from secure to unsecured credit. And I'm going to show you a little bit more how I will think about it in a slightly different way in a second. I think this is the picture that really summarizes everything. As you saw, there's a lot of pieces, and Viral went in quite a good amount of detail into a lot of them. But this is really, the first picture gives you this date 0 surplus. The second picture gives you the date 1 surplus. And then if you add them up together, you're going to get the one at the bottom. And the date 0 is this notion that more credit can be extended early on. Date 1 is this notion that, as safe harbor gets bigger and bigger, there's going to be more liquidations. Let me just highlight that on the x-axis, we have this Q variable. Okay, so right now, the real world is Q equals 1, and then you can think about us moving to the left. And then, I don't know if you, it's a bit hard to see, but if you, this is the part that's sort of what the paper is about. I'm going to zoom it. You see the peak over there. That's the result. I mean, I think that's the key result of the paper, which Viral showed you actually analytically, which is like, you want to be, can I go back? Yes. You have all these regions, but in the first dotted line to the right, you enter into the fire sale world, okay? And the key result of the paper is that you want to be exactly there, you see, in that peak. That is really, it's a bit hard to see because of the numbers, but that's really this is a theoretical result, and you show it, I won't call this a calibration in this illustration of the paper, and I mean, that's really what the paper does. Now, what is the bottom line? You know, our status quo is Q equals 1. If you, again, I don't want to take the numbers seriously. I want to say a bit of the message of the paper is that the number should be much lower. Okay, let's not focus on 0.15, could be small. And you know, the message really is that the paper has the main message is like, you really want to set this Q, you want to have the safe harbor all the way to the point where there's no fire sale whatsoever. Okay, so bottom line will be to a policymaker when we'll say, figure out the number that gives you never a fire sale, that's the number you should be setting. I think that's, you know, in a sense, this kind of the one-line version of what the paper is trying to say. I'm sorry, I want to move forward. Okay, so I mean, these are all first-order trade-offs. I think we all agree with that. And you know, to me, I mean, this paper has more of a sort of quantitative flavor in the sense that at the end of the day, this really becomes a quantitative trade-off, okay? And I think what the paper, I mean, it doesn't have to be this paper, but I think where the next step in this question for the repo market is towards quantification. So what I'm gonna do in the next few slides, I'm gonna derive a related but slightly different version of what Viral is trying to do, and I'm gonna give you a little framework that allows to push this question towards the question of what we need to measure to answer this question, okay? And it's built on some of earlier work that I've done. I think a number of you may know that paper, but it's really trying to tell, I'm going to end up saying that the response of the repo rate to things is going to be really important. I'm going to kind of try to argue why that's going to have a lot of information to answer quantitatively the question that sort of Viral is posing in the paper, okay? Another remark I want to make is, and I think Viral pointed this out in the talk, it's not so much in the paper. There's a large analogy to the question of consumer bankruptcy here. You know, I know Dean is there, for example, and this is the literature that has, you know, started more theoretical and had like this very big quantitative work. And there's a very similar trade-off in this kind of literature. Okay, I want to highlight the following. When we say bankruptcy exemption in the personal case, it means exactly the opposite when you mean here. There is like if you have an exemption that is higher, the lenders get to recover less. In this repo world, the way it's used is exactly the opposite. But the trade-off is very similar. So if you make lender recoverability, whether that means higher, in the standard bankruptcy case, you're going to have more borrowing and cheaper rates for lenders. And then in the other case, you're going to have typically kind of less insurance. You lose some state contingency exposed. Now, the analogy is a little bit imperfect in the sense that this literature is mostly based on unsecured credit, and we're talking about secure credit, but I want to talk about this in a second. The other literature is a little more about risk sharing, and this is about investment efficiency. But I really think, you know, overall, there should be a little bit more connection. Okay? This is the international work, but that's a little bit different because there you don't get to choose these things so easily. That's more like self-enforcing than this kind of work. So that's sort of something that, to me, you know, it was very, very, very clear there was a deep connection. So let me just walk you through my version of the model. I'm going to just, you know, it's going to be very simple, few equations. I think that what Viral did, and then what I'm going to do is I'm going to show you one environment, and then I'm going to tell you how to do this welfare assessment and what it depends on. And then I'm just going to give you a few final comments, okay? So my environment's going to have a bunch of risk-neutral borrowers, and you know, they're going to choose borrowing at date 0 and default at date 1. That's kind of the two basic decisions you need to take here. That's the budget constraint. They have some N is some initial net worth. They can eat or invest, and then they're going to raise some funds. This Q function, let me call it a pricing function or credit surface. My colleague John G will kill me if I don't say the word, so that's why you put over there. And then at day 1, you know, you have these borrowers. What is their consumption? Well, if they're going to take the capital, they're going to invest, they're going to get some return on the investment. The S is going to be the state of nature. It's like a state here. And then if they repay, they get that. And then if they default, I'm going to assume they get nothing. And at day 2, their payoffs are going to be, well, if they repay, they're going to get the asset back. I wrote the asset AI in gray because it's at the beginning, it really doesn't matter. But kind of the whole point is that if you repay this B1, you're going to get your asset back. That's the whole point of the repo contract. And if you default, you will potentially have to pay back what you have. Okay, this is it. I think it's kind of a very simple version of how you can write the repo contract. Now, how the default takes place depends a little bit on the assumptions that I make. Could be a liquidity default or not, but there's going to be some condition. You can see right away that if S is sufficiently low, there's going to be a forced default here right away. So it doesn't really matter for what I'm trying to say. I say there's going to be some region in which there's default here, and then we can have slightly different assumptions. So this is the model that I have in mind. And what is critical here are the lenders. Okay, so what I'm writing here is this pricing scale that the lenders are going to set. This is, remember, what you can see up there. That's the funds raised function that I told you. And this is going to depend on three things. So if there's repayment, well, you have here the expectation of B1, which is the amount of debt, so that's going to be priced. And then this is kind of the meat of the paper. I'm going to use H instead of Q because Q is sometimes used for other things here. So H means for me harbor. Okay, so high H means more safe harbor. And the way I would like to think about modeling this is to say, well, look, if H is 1, we have those are the payoffs that go to the lenders. And that looks like collateralized credit. Let me walk you through the notation because it's a little bit messy. So it's P of parentheses times A. So P times A is price times quantity. That's typically what we have when we look at collateralized credit payoffs in case of default. And the price will depend on the sum of the assets over all the people who are defaulting. That's what I'm trying to say. The fire sale is there. So if there are many people who are defaulting, these A assets will be dumped, and there's going to be a price that depends on that. So the payoff when in the secure default piece is going to depend on all of that. And then if you have, if you are kind of in the version in which you don't have the secure version or the safe harbor, then you're going to get an unsecured default payoff. Okay, so the way I see the world about the way I would model this, the parameters, sort of, I would say, with some probability, the asset has a secure payoff for the lender, so with some probability, it has to have an unsecured payoff, or you can think about a fraction of the asset has secure and a fraction of the asset has unsecured payoff. And Viral's experiment of moving this Q is my experiment of moving H here, and what I'm going to do in my last slide or two is to just show you how the welfare looks like when I do that. Okay? I wanted to say that this P function, we can build it from outside investors. Viral did it in his paper. There are different ways in which you can do it. This is the whole fire sale literature. You get this downward sloping demands, but there are different ways in which you can do it. All right, so this is my last slide with math, and then I just make the comments, okay? Perfect. So how does welfare change when I change this parameter? Well, in this model, if you assume the lenders are risk neutral, you can forget about them, so I can focus on the welfare of the borrowers. And you do a little bit of envelope theorem. I'm going to spare you the envelope theorem here. You're going to get two things. The first thing is what is sort of holding fixed everybody's borrowing decisions, how this pricing function changes. And if you were to go through the steps a little bit, this is essentially going to be the difference between these two payoffs, essentially. So if the payoff, you can kind of take the derivative in your head on the H, is the difference between that object and that object, okay? That's going to be typically, it's going to be typically positive. And this is the whole effect of you can raise more in the collateralized version. So if I do a contract that is more collateralized, I'm going to be able to raise more, and then there's going to be cheaper credit. And then this is the whole externality thing. In my derivations, there's all this VII there in the default region. Okay, and those are where the externalities are. Those coming through the prices. So if you, I'm sorry again with that thing. If you go through a little steps, you're going to get that the other term that survives is the sum over the people. This is for agent I. The change in the welfare of agent I has to do with what everybody else is doing with their borrowing decisions. And this is what's really working through the prices and through the externalities. And this is typically what's going to be negative. So this is kind of my simple version of Viral's point. Now, I want to make two small remarks. So the papers focus on the liquidations of the collateral. They could also be, the capital could also be liquidated. So it could be more externalities if we want. And this is coming through investment. And I'm missing a bunch of other forces here. So rollover is something that I think is not quite in the paper, but a lot of the repo issues have a rollover component. This connects a little bit to some stuff that Manuel and Javier have been doing and how prices enter default decisions. There could be also difference in valuations we're assuming risk neutrality, but again, if you think through, for example, consumer bankruptcy, a lot of the difference come from different valuations are also there. But the broader point I wanted to make is like, if you look at those equations that I have there, this Q function, this repo rate function, has a lot of information to answer the welfare question. Okay, so if I were like a clever empiricist with access to the repo data, which I believe is not that hard, I would be looking at some of these objects and try to build in and see how important they are. I see Arvin nodding. I think he's done a lot of empirical work on this, so that would be useful. So in my last, I'm probably out of time, 1 minute, let me say a few questions. The broader question is, should financial contracts be collateralized or not? Not just repo. So I think for me personally, for this research agenda, I would like to have an answer of the form, for which assets do we want to have collateralized or not collateralized contracts? And I think Viral tries to give an answer to this. It's just kind of one application, but I think this is the really big question. And I don't think I could give you an answer on the spot. Second, I think this is also really important. The paper connects 100% seizing collateral with liquidating collateral. And you know, my model too, by the way. But I think one could think about a world in which like we separate the seizing from the liquidating. So I'm just thinking of a contract of the form, there's safe harbor in the sense that the asset is yours, but you don't get to liquidate it for like 30 days or 60 days. And I think that might ameliorate some of the things. And it's not something I've seen proposed, but maybe that's something that comes right away once you think through the logic of this, okay? And you know, if it's treasuries, I don't think it's such a big deal in terms of pricing because they're treasuries after all. And I think I'm out of time, so let me just look at the last point, which is, I think we're all just some empirical papers. I'm not sure how big the fire sales are in the collateral of treasuries, how, you know, it's a very liquid market. So I thought that maybe some of the MBS or the other less liquid contracts this seems to be more important there, but that's like a smaller point. Let me skip the last point. So I think I'm out of time, so let me say, really interesting analysis, a very important question. Very clear for sort of trade-offs. I think the frontier in the questions will be more pushing more towards the quantification. I mean, I hinted at a way to do it, and you know, looking at repo rates and how they vary with different things, either directly on the data or maybe with them all. And yeah, and I think the big question of what should be collateralized, what shouldn't be, is still not fully answered. Thank you.
Thank you, Eduardo. So, Arvin.
Two questions which I think are related. One, Viral, if I understood your last comment, it is that once you have the optimal bankruptcy exemption, there's no more room for a leverage requirement. But I presume it also means that if you could implement the same thing with the leverage requirement without a bankruptcy exemption, you can clarify that. Now, I wonder if here's a way to break the tie, which is one thing that's missing in your model, which I think is actually quite important in the world, is that the repo exemption allows the collateral to be repledged. You know, there's like a very important part of the repo market is that I lend to you, I get the collateral, I take the collateral, I pass it on to somebody else. You know, this is the rehypothecation thing, which basically makes treasuries a kind of a form of circulating money. It also, another important aspect of the bankruptcy exemption is that it gives lenders the right to substitute collateral, right? Like I borrow against 5-year treasuries and I say, no, really I want to borrow against 10-year treasuries. I take the 5-year treasuries, put them away, give you 10-year treasuries. The contracts are designed to allow you to do that. So there's a whole collection of activities that exemption allows, which is not present in your model. In your model, it's just really just collateralized borrowing. Anyway, so it feels like that breaks the tie, and then it suggests like maybe the right thing to do is leverage requirements and keep the bankruptcy exemption.
Sorry.
Yeah, so a couple of things. One of them is a little bit of a follow-up on what Arvind was saying. I'm trying to understand why you get such a sharp result that you go so far and no further. And one possibility is the kinds of considerations that Arvind was raising. The second is, does it have something to do with the timing of the realization of the uncertainty? You chose a very clever kind of timing there where you see the uncertainty at the beginning. You know what I mean? And then after that, you write down your contract. If you changed it so that you wrote your contract and then you got the realization of the uncertainty, even if you could condition on it, it means that the size of the fire sale externality is different. There's a second, which in the spirit of Arvind's question about broadening this, one thing that's always puzzled me about bankruptcy procedures is it's not obvious looking at it from the outside why, other than the pecuniary externalities you brought up, why you would want the government at all to regulate the bankruptcy procedures. Why can't I incorporate that in my financial contract? Or an alternative, why don't we give people different alternatives, much richer than Chapter 7 or Chapter 11, much richer alternatives. You can adopt a form of financial contract where you violate it, you go to debtor's prison. On the other hand, something else where, yeah, I don't repay, and that's okay, it's forgiven. Why don't we see more choice? Most of our models would say that you should see more choice. So that's speculative. Maybe we talk about it at beers, but it's something that has always troubled me.
Yeah. Okay, so a quick question. So I guess, this idea of what happens in default. So the one benefit of having these very clear safe harbor is that they can just take care of it. But I think the more and more we move away from that clarity, in our models we could say, well, maybe they don't get anything. I'm thinking about bankruptcy more generally, but in practice it doesn't happen. So in the case of sovereign debt markets, defaults is like the prime example of a lack of clarity of what happens after a default. And what ends up happening there, of course, is these extensive renegotiations, bargaining, and so forth, that is just creates a lot of deadweight costs. So, I just want to, it's a note on moving away from very clear effects from bankruptcy.
Okay, one final question, and then Viral, you have 1 minute to answer everything.
I think Doug.
Can you hear me? Yeah. The role of sort of short-term debt is sort of hidden in this model. I mean, it is one period and things like that, but there's a notion that if you think about the money market funds, that's a way of creating, repos are a way of creating short-term debt that can be held by households. And if you took away, the way regulation works, if you took away the automatic stay, that would completely shut that down, right? Because you wouldn't be able to take the repo because you couldn't take the, presumably you wouldn't be able to. So I'm wondering if, in some sense, some of this is related to sort of private sector liquidity creation, competing with the government and competing with banks and things like that, and whether you could think about that as an important margin.
Viral?
Yeah, no, great questions and great discussion, Eduardo. So I fully agree. I think we should do some quantification. We've just started understanding the sufficient condition for this result to hold a little bit more deeply. It turns out it's a very weak sufficient condition, so we are trying to strengthen it. But I think your decomposition is very, very interesting. Just one point I wanted to make on this seizing versus liquidating is that in a way, what the model is implicitly saying is that maybe the insiders of the industry, which is other financial intermediaries who are surplus, are the best owners of these assets. And if you allowed these folks to not liquidate it, but seize it, and maybe then there is some friction in them going to like sell it to these folks, then there could be a misallocation inefficiency there, which is that maybe money market funds don't have great expertise as broker-dealers do in managing the collateral, or maybe they don't have alternative uses for it, and then that could be an effect. Yeah, so I don't have a sort of exact sort of proof right now to in response to Arvind's question, but I think the intuition of the model is that Q, which works in a very state contingent way, in taking away the creditor right when the fire sale matters the most, is a more powerful way to actually limit leverage than restricting ex-ante leverage itself. Maybe we should stress this aspect a little bit more, that it's not just that once you are at optimal Q, you don't want to change anything. It's actually the case that restrictions on Q are a better way to implement efficient welfare than than the capital requirement itself. Yeah, I fully agree about the repledging, the creation of money. I think it links a little bit to Doug's question as well. So I think that's sort of maybe a little bit of an elephant in the room, which is, did safe harbor actually make all these things possible? What it does in the model is that it does make it possible because it allows, through this expectation of a higher price, greater funding ex ante. But the model just maybe, to put the model not so starkly, I would say that maybe there's a leverage counterpoint to that creation of money, which of course a lot of the literature like Stein is pointing out that maybe creation of money creates these problems because then we lever it up. And maybe, as I was saying, if I was self-critical, I didn't need to write down this model. Maybe Stein's intuition sort of carries through that you will get excess leverage if you're trying to create money-like contracts. And maybe that's what we are documenting as well. So I think there was a question by Chari on why not regulate bankruptcy procedures. So yeah, I think that's an interesting question. I think it's almost a little bit of a historical question as well, which is the need to regulate leverage really come about because we are now willing to create. I think I was getting at this in the end towards the LOLR discussion, which is, we had unlimited liability in banking, for example. Bankers were willing to say, oh, I'm willing to set aside money to dip into my pockets when I will be bankrupt, so I'll go beyond my limited liability. And the question is, why did that disappear? Banks used to hold a lot of capital and liquidity. So my favorite example is that when the accounts of banks came out, bankers would stand outside branches showing depositors, oh, I have very high capital, very high liquidity, why don't you come to me? But we don't do that anymore, and the question is, why has all this gotten crowded out? But I think our model probably can't answer that. Okay,
Yeah.
I should stop.
Thank you very much.
Thank you so much. Yeah.
Got a break now, 10 minutes.
Well, first, I'd like to thank the organizers for inviting me to present this paper at such an exciting conference. And I'm always happy to be back in Minneapolis, as I was mentioning earlier. This paper is joint with Garth Boffman, who is also at the board, and so the usual disclaimer applies. The motivation for the paper is given by the fact that a key objective for central banks is to provide the economy with the necessary liquidity to achieve their mandates. Given that observation, the objective of this paper is to analyze the tools for providing such liquidity in unsecured interbank markets, such as the federal fund markets. Now, the tools employed by a central bank to provide liquidity are the tools employed to conduct monetary policy, and they're usually known as monetary policy implementation framework. The fact that the nature of this interbank market is unsecured is important because in unsecured markets, an agent can't be forced to repay his debt, but it must be in his best interest to do so. And this gives rise to borrowing subject to an endogenous limited commitment constraint, which I'll discuss at length. So with that in mind, our analysis delivers two results. The first is that if central banks run a floor system, then interbank trade collapses. But it does so not because banks do not want to borrow. It does so because banks are unable to borrow given the fact that in equilibrium, the endogenous borrowing limit collapses to zero. A floor system is an equilibrium where the interbank market rate equals the remuneration rate on reserves, and I'll describe that in detail. The economic mechanism behind this result lays in the endogenous nature of the borrowing limit, which is similar to P and Levine. So agents preserve access to interbank markets if and only if they plan to honor their obligations. Access to the market is valuable because it allows agents to reshuffle liquidity after they experience a liquidity shock. So collectively, as a group, ensuring that liquidity shock allows them to carry over fewer balances intertemporally. Instead, agents without market access need to self-insure, and they do so by carrying reserves intertemporally. But that is costly in our economy due to inflation because we are away from the Friedman rule. So despite banks are awash with reserves in equilibrium, interbank trade is beneficial because it avoids that inflation tax, given that we're away from the Freeman rule. Moreover, when banks are awash with reserves, they actively trade in the market, the interbank market, less frequently. But the unsecured nature of interbank market implies that a borrower today is trustworthy if he needs to borrow again in the future, because that's when he's going to value having a good reputation for having repaid, if he's going to need access to interbank trade in the future. Therefore, when banks are awash with reserves, the borrowing limit collapses to zero, even if there is positive demand for loans. Then our second result is a proposal for an alternative framework to implement monetary policy, which we label a Voluntary Reserve Target Framework, or VRT, that preserves interbank trade because it introduces a motive to borrow and lend independent of aggregate liquidity, that is, independently of aggregate reserves in the economy. Because it preserves interbank trade, it relaxes borrowing constraints and it improves welfare. But importantly, it does so not by relying on swapping assets with different liquidity properties, such as reserves and treasuries. It does so just because of how the central bank injects a certain amount of reserves in the economy. It's about the rules that the central bank follows to inject liquidity. So it is about the mechanism adopted to implement monetary policy that matters for welfare, and it is an integral part of monetary policy making, as well as choosing an interest rate or an inflation rate. A VRT is a framework where banks choose a target for reserves holdings, and obviously I'll describe that in detail. So we take seriously a feature of interbank market in the US and elsewhere, that is, they're unsecured. And with that, our results and economic mechanism are consistent with empirical evidence in several countries. In the US, where the federal funds activity collapsed right after the great financial crisis, it was characterized by virtually no bank-to-bank trade, but by what is known as arbitrage trade. And it's been characterized by reluctance to lend excess reserves that has amplified some stress events, such as the September 2019 event, where the repo rate spiked and the federal funds rate spiked. But also in the euro area, quarterly turnover in unsecured interbank markets dramatically dropped in 2008 and for the last 15 years. But interestingly, it shifted to the secured segment of the interbank market. That is important because it shows that these banks were not awash with reserves and without the need to borrow. They needed to borrow at the point that they chose to move to the more costly segment of the interbank trade, where they have to secure their loans. Finally, the Central Bank of Norway moved away from a floor system in 2010, exactly mentioning as a rationale to do so that banks were no longer using the interbank market to diversify their liquidity risks. And that is exactly what the interbank market does in our economy, allowing this insurance of liquidity risk. The second result speaks to the importance of the implementation of monetary policies as an integral part of monetary policy making, because it affects welfare. And because of that, we should not think of monetary policy implementation as a detail left to central bankers, but we should be carefully thinking about it at the same time as we think about the choice of an inflation rate or an interest rate. So the model economy lasts forever, and time is discrete, where each period is divided into three markets. First, a settlement market, where money is issued. In a model, I will talk about money, but I would like you to think of this as central bank reserves. Also in the settlement market, loans that originated in the previous period are repaid or not repaid. Those loans of money originate in the money market, where money is borrowed and lent, subject to that endogenous limited commitment friction. And then finally, the goods market opens, where money is exchanged for consumption goods. It gives utility, but you can equally think of this goods market as an investment market, where money is exchanged for productive assets, and those productive assets generate profits in the portfolio of the bank. All markets are Varasian. The economy is populated by a measure one of buyers and a measure one of sellers. Buyers are going to buy a consumption good for sellers and get utility out of it. But I would like you to think of buyers as banks and sellers as broker-dealers. The broker-dealers are going to sell some assets to banks, and banks generate profits with those assets in their portfolios. This is the intuition that I would like you to keep in mind when I talk about buyers and sellers. There are two consumption goods, one in the settlement market, and it's denoted capital X, and it is the numeraire good, so it is used for debt settlement. And another one, denoted by little q, that is in the good market, and that is used to generate the need for money. And this little q is what I would like you to think also of as an asset that broker-dealers sell to banks to generate profits in their portfolio. That's this little q. Preferences of buyers and sellers in the settlement market are linear in the consumption of the settlement good and this utility of labor to produce that settlement good. Preferences of buyers in the goods market are represented by a standard utility function, which is mostly log, and scaled by a taste shock or liquidity shock, represented by a random variable epsilon, that's IID across time and agents, and whose realization takes place at the beginning of the money market. The seller's cost of producing that good is linear. On a timeline, within a period, we have the three markets, the settlement market, the money market, and the goods market. I'm going to start from the end and walk my way back to the beginning of the period. At the end, in the goods market, buyers purchase good X from sellers, and they enjoy utility from consuming that good, scaled by their liquidity shock epsilon. Then any money that's not spent to purchase Q can be deposited overnight at the central bank. And I denote those deposits by D. Then going backwards, in the money market, that's where buyers experience their liquidity shock or taste shock epsilon. And given that shock, they will want to borrow or lend money. And these contracts in terms of money are loans, are denoted by L. And that's subject to this endogenous borrowing limit, which I'll derive in a moment. And then walking again backwards to the settlement market, that's where loans originated in the previous period are repaid or not. Overnight deposits from the previous period are remunerated by the central bank with remuneration function R, which I will describe. And agents can buy money at a price phi. So phi is how many goods X need to be exchanged for 1 unit of money. We focus on stationary equilibria where the inflation rate, denoted by gamma, is constant and exceeds the discount factor so that we are away from the Friedman rule, and in equilibrium we can have credit. Now, for the endogenous borrowing limit, we assume that buyers have access to a record of all money market transactions and settlement market transactions. The money market transactions are where the loan originates, and the settlement market transactions are where that loan is either repaid or not repaid. Did you want to ask a question, Marco?
Yes. I was trying to figure out, so you mentioned that money is reserves.
Yeah.
So if you could go back to the previous slide, please. So why doesn't money then pay in the next one?
Let me get to the implementation framework. I'm going to describe that.
Okay, because under the floor system, I thought the interest rate on that money would be equal to the interest rate on the Fed funds market.
Yes, am I not? Yeah, I thought, let me say, yeah, that's what I think, yeah, that's what I highlighted exactly at the beginning.
Okay.
And I will formalize that. Okay. So, so let's go back to the endogenous borrowing limit. We have this record of all money market and settlement market transactions. Those are the transactions where the loan originates and the loan either gets repaid or not. And we focus on equilibria where the off-path punishment is being cut out of money markets. And we call those agents who would be cut out of money markets autarchs. Autarchs can still consume in the goods market, but because they have no access to the money market, in order to do so, they need to hold money to make that purchase. Instead, buyers with access to the money market can borrow in the money market at most what makes them indifferent between repaying and defaulting on that loan. By default, here we mean failure to settle, to repay that counterparty at a specific time. so what are known as settlement failures, and we can talk about that later, about the data and what we know about it. So it is not necessarily bankruptcy filing. So the payoff from repaying is given by the cost of working to repay nominal loans L cum interest, 1 over rho L, at price phi, because you have to work to get X units of good for each unit of money you want to pay to repay that loan. And your continuation value for being in good standing, having a good reputation, is VB, for being a buyer. If you do not repay your loan, you have a continuation value VA for autarky, because you're cut out of money markets. We can rearrange this constraint by letting B denote the nominal borrowing limit, that is just the difference between the value of repaying and defaulting scaled by the price level, so that we have a simple endogenous borrowing constraint. So in terms of implementation frameworks and reserves and remuneration market, we start from a benchmark that is our VRT. Its elements are a target T that is chosen by agents and exogenous policy rates, rho T for remuneration of reserves up to the target, rho E in excess of the targets, and rho P that is the penalty for missing the target. Then we consider a flat rate remuneration schedule, that is a little bit what we have at the moment. That is a special case of a VRT because there is no difference between the remuneration rate up to the target and in excess of the target. They're all the same, and there's no penalty at all. Then a floor system is an equilibrium that is a special case of the flat rate when the money market rate, rho L, equals the policy rate, the remuneration rate on overnight deposits at the central bank. And we'll discuss that. So in terms of actions and events for the remuneration of reserves, at the beginning of the settlement market, before entering the money market, agents announce their target choice. So before they know their epsilon shock, they choose a target. The central bank then takes overnight deposits at the end of the goods market and remunerates them in the following settlement market, so that given a choice of target and deposits R, the remuneration function is such that reserves up to the target are remunerated at a rate 1 over rho T. Any deposits in excess of the target are remunerated at a rate 1 over rho E. And any shortage of reserves with respect to the targets are charged a penalty rate 1 over rho P. Now, these rho's are the inverse of the rates, and it's just mathematically cleaner to work with them. On a diagram, we can see that remuneration of deposits at the central bank with the deposits or reserves on the x-axis and the remuneration function of the y-axis. So given a target T, any deposits up to the target receive remuneration RT, but also because they forgo the penalty rate, effectively they also earn RP. If agents fail to meet the target at all, then they're charged the penalty rate on the entirety of their target chosen. Any deposits in excess of the target earn RE. With a flat rate remuneration schedule, this diagram looks like a straight line coming out of the origin, because it's just remuneration of reserves balances, and that's it. Then the value of an agent entering the period with targets chosen in the previous period and a portfolio of loans and deposits coming from the previous period is to choose how much money M to carry within this period, their choice of targets for this period, and their settlement market consumption and labor to maximize settlement market consumption net of labor and the expected value of accessing the money and good markets, subject to a budget constraint where purchases of settlement market good and money need to be funded with reserve remuneration by the central bank, net of loan repayments, labor effort to produce the good X, that's income, net of any lump sum tax or transfer that the consolidated government budget constraint may charge. In the money market and goods market, the value of a buyer receiving shock epsilon and having chosen at the beginning, not getting there, targets T, and money holdings M is to choose consumption Q, overnight deposits D, loans L, to maximize its utility of consumption scaled by their taste shock epsilon and the present continuation value, subject to a budget constraint that tells us that consumption expenditure plus overnight deposits need to be funded with money and loans, and the endogenous borrowing limits that caps the amount of loans that you can have. For an autark, the decision problem is very similar. There are just no loans appearing here because it's cut out of money markets. The policy function for consumption in a VRT can be shown as a function of the liquidity shock epsilon. And in this diagram, I show in black buyer's consumption allocation and in red the autark's consumption allocation. They're characterized by endogenous thresholds for this liquidity shock. So if the liquidity shock is very low, below epsilon L, these agents are lenders in the money market. Their taste shock is so low, they don't have value for consumption, they're going to lend in the money market. Between epsilon L and epsilon B, these agents want to consume more, so they borrow in the money market. Their consumption increases with epsilon, and they're not borrowing constrained. Between epsilon above epsilon B, they're borrowing constrained. In particular, between epsilon B and epsilon T, their consumption is flat because they prefer to meet the target. After epsilon T, they start missing the target, but their taste shock is high enough that they prefer to increase their consumption, giving up the target, up to the point, epsilon M, where they put everything they have in consumption. They miss the target entirely, and they spend all of their wealth in consumption, and that's why it's all flat. For autarks, it's exactly the mirror image of that, just with different endogenous thresholds because of the lack of market access. With a flat rate remuneration schedule, the consumption allocation looks very similar. It just has fewer kinks because there is no target investment opportunity. The only reason why they're borrowing constrained or not is, do I want to borrow to eat, to consume, or not? But conceptually, it's the same. So our first result is that in a floor system, no credit is feasible in equilibrium. And again, a floor system is an equilibrium where, of the flat rate remuneration economy, where in equilibrium, the interbank money market rate equals the deposit rate, the remuneration rate on overnight deposits. It is rho E. So when that is true in equilibrium, when rho L equals rho E, then the value of a buyer equals that of an autark, and the endogenous borrowing limit collapses. Let me highlight that this situation with rho L equals rho E is what has characterized most of the past 15 years in the US. In terms of primitives, that rho L is an endogenous object. In terms of primitive, a floor arises when overnight deposit remuneration at the central bank compensates at least for inflation. Again, this is also a feature that has characterized most of the last 15 years in the US. And when this inequality is strict, this equilibrium is unique. So the equilibrium with a floor system and a zero borrowing limit is unique. Now, this happens because when deposit remuneration compensates for inflation, even if we are still away from the Friedman rule, then holding money is not too bad of a portfolio choice for agents. But with large money holdings, agents rarely need to access the money market to borrow. But that's exactly that rare need to borrow that kills credit in unsecured money markets. Because with an endogenous borrowing limit, with unsecured money markets, it is exactly the need to borrow in the future that makes a borrower trustworthy today, because that's when he's going to value having a good reputation. In other words, when the deposit remuneration compensates for inflation, the payoff from defaulting, that is autarky forever, is not bad enough to incentivize current repayments. The proof comes straight from looking at the first-order conditions for money holdings for buyers and autarks, where we see the marginal cost of holding money, that is inflation multiplied by 1 over beta, that's implicit interest rate, that equals the marginal benefit on an extra unit of money. For unconstrained buyers, that's 1 over rho L, because they're either going to lend at that rate, or by having an extra unit of money, they do not need to borrow. So they do not need to pay the 1 over rho L rate on the loan. for constrained buyers is the marginal utility or consumption being constrained. And with log utility, that's why you see the epsilon b showing up there, because that's when they're borrowing constrained. For autarchs, it is pretty much the same. The only differences are the endogenous thresholds. Those are endogenous. And the fact that they do not have access to the money market. They only have access to the deposit remuneration at the central bank. But then you see that when rho L is equal to rho E, these equations are exactly the same. And so the endogenous variables are the same. That means that the first borrowing constrained buyer, epsilon b, who can borrow, equals the first money constrained autarch. So that means that buyers and autarchs choose money holdings so that they are constrained exactly at the same point, exactly for the same realization of epsilon. But then, when this happens, basically they have the same real value of means of payment, because the costs and benefits of money holding are the same. So what happens is that buyers' real money holdings and real borrowing capacity is the same as the real money holdings of autarchs. That is to say, they have the same purchasing power, so they consume the same allocation, and they are indifferent between having access to the money market or not and being in autarky. And that's what makes the value of a buyer equal to that of an autarch. And so no lender is going to trust a borrower. And in a stationary equilibrium, the borrowing limit collapses to zero. Now, the uniqueness result that's driven by the parameter conditions that deposit remuneration strictly exceeds inflation comes from examining the equation that pins down the borrowing limit. That is a function of real money balances phi m and the differential in expected utility between buyers and autarchs. Now, that equation is strictly monotonic in rho L, and rho L has direct effects on real money balances and the differential on expected utility. That direct effect combined is strictly positive. But the indirect effect through the marginally borrowing constrained buyer is positive if deposit remuneration exceeds inflation. The reason why that is so comes from the elasticity of substitution between real money holdings and real borrowing. That is an increasing function of gamma rho L. That is to say, it's an increasing function of inflation and the money market rate. So the larger inflation and the lower the money market rate, the stronger is the substitution away from money and into borrowing. Because money is costly, and with a lower market rate, borrowing is not that costly. And you would like this substitution to be strong in order to have a positive demand and supply of loans. But the remuneration rate on overnight deposits by the central bank caps the market rate because it provides an outside option to lenders who can either lend on the market or deposit overnight at the central bank. So effectively, rho E caps that elasticity of substitution between borrowing and money. It's a bit like a zero lower bound problem, just at rho E. So nobody borrows, and the market rate equals the remuneration of deposits at the central bank. Now, why, I have 10 minutes, why endogenous borrowing limits are key for this result? And consider first frictionless markets. If the money market is at the floor, at the deposit rate, then for lenders, lending and deposit at the central bank yield the same payoff. They're indifferent. But borrowers would be willing to pay 1 over rho L, that is a higher rate than the remuneration on deposits, in order to avoid carrying money balances to the next period, because those money balances depreciate overnight, are subject to the inflation tax. Therefore, at the floor, when rho L is equal to rho E, it is necessary that borrowers do not demand loans to have that floor. But that happens only at the Friedman rule. And the same is true for exogenous borrowing limit, because borrowers always would be willing to pay a little more. They need to not demand loans for the market rate to be at the floor. Now, with endogenous borrowing limits instead, the borrowing capacity of an agent collapses when the borrower is indifferent between repaying and defaulting. Now, if he defaults, an agent carries money balances on average overnight, and that earns 1 over rho E, but it has to pay the inflation tax. Instead, agents who repay as a group collectively, they carry no excess balances. They just reshuffle more efficiently the liquidity amongst themselves, and so they avoid the inflation tax. Therefore, the endogenous borrowing limit depends intrinsically on the difference between inflation and deposit remuneration. And when deposit remuneration compensates for inflation, there is no value for future market access, and that's why the borrowing limit collapses to 0. Our second result is that a VRT revives trade, and let me say that's a result that holds even away from the floor. And we derived that in a 3-type economy so that we can analytically characterize the result. I'm going to construct the equilibrium in the flat rate economy and the VRT economy so that I want to give an additional motive to borrow and lend to at least some of these agents. And these are going to be the epsilon 2 agents, the one with the middle realization of the shock. So I'm going to construct the equilibrium so that in the VRT, agents experiencing epsilon 2 want to borrow to meet the target, whereas in the flat rate remuneration, they would lend. Similarly, for autarchs experiencing the shock epsilon 2, they would want to give up consumption to meet the target, whereas they would deposit in the flat rate. So remember, the idea here is to construct this equilibrium so that there is value of accessing the market. There is value in having a good reputation. And here, the way that I'm doing that is by making it valuable for buyers to be able to borrow rather than giving up consumption to meet that investment opportunity, to meet the target. So under some sufficient conditions that guarantee that the VRT equilibrium I described exists, and other sufficient conditions that guarantee that the equilibrium I described in the flat rate economy exists, if the penalty rate is above a lower bound, then the borrowing limit in the VRT economy exceeds that in the flat rate economy. And the idea here comes, again, from the equation for the borrowing limit. If we compare that equation in the VRT and the flat rate economy, conceptually, they're similar with the gap in real money balances between autarchs and buyers and the differential in expected utility. But the difference is that in the VRT, there's now targets that adjust endogenously, and even buyers are going to take advantage of that deposit opportunity wanting to meet the target, whereas before, only autarchs would deposit overnight, whereas buyers would be able to lend because they had access to the market. So to see the role of targets here, fix a flat rate economy, and let's concentrate on the VRT and its key parameters. So the penalty rate affects the choice of targets by agents. That's going to affect endogenous variables, the inverse of the money market rate, and the marginally constrained, borrowing constrained buyer, which in turn affect money holdings and differential in expected utility. So ceteris paribus, with a higher penalty rate, target choices decrease because that's more expensive to miss it. So buyers now are going to need to borrow less, because remember, they were borrowing to meet the target sometimes, but also they want to lend more, exactly because they lowered their target choices. So the market rate decreases, that is to say, rho L increases. And it means that lenders are more willing to consume than to lend, because the lending option was distorting their consumption allocation. And for constrained buyers, it means that the borrowing constraint is relaxed, because rho L, as a inverse of the interest rate, comes straight through the borrowing limit. So in the same diagram denoting the consumption allocation I showed you before, what happens when rho L increases, that is to say, the money market decreases, 1 over rho L, is that the consumption of all these lenders increase, and that the consumption of constrained buyers increased because the borrowing limit increases with the direct effect of ROL. Now, there is also an effect through the endogenous thresholds of borrowing-constrained buyers and money-constrained autarchs. And ceteris paribus, with a higher penalty rate, both buyers and autarchs reduce their target choices. But this is more so for autarchs because they cannot access the money market. Buyers, instead, they can reshuffle liquidity in their money markets. So they can take advantage of that investment opportunity offered by target remuneration at a lower cost than autarchs, because by reshuffling liquidity collectively, buyers need to bring less money into the next period. Bringing money is costly due to inflation, so they avoid that inflation tax. So that implies that relative to autarchs, buyers become constrained later. So that threshold, endogenous threshold, increases more than it does for autarchs. So buyers are relatively less constrained than autarchs, and that implies that the value of a buyer increases with respect to that of an autarch in a VRT relative to a flat rate. And again, this is true even away from the floor. With respect to, again, it looks ugly. Let me just point to what I want you to see in this picture, because that's the same pictures I've been showing you before, building up to it. What happens here is that, remember these kinks? I'm showing you again in black the VRT, and now the solid line is buyers and the dashed is autarchs. In red, I have the flat rate, solid line buyers, dashed line autarchs. Remember that the kinks denote the first constrained agent. And what you can see is that for buyers, the first borrowing constraint agent now is further apart from the first money constrained autarch with respect to the blue dots that describe that endogenous thresholds for a VRT. And that is exactly what I was suggesting, that implies that buyers are relatively less constrained, and therefore the value of a buyer increases with respect to that of an autarch. So to conclude in this paper, we analyzed interbank trade, taking seriously a feature of those markets, that is, trade is unsecured. And we show that implementing monetary policy with a floor system kills trade because borrowing is not incentive compatible. Because remember, those epsilons go up to infinity. There is always somebody who would be willing to borrow. There's always a positive demand for loans. And then we show that a VRT framework can revive trade and improve ex-ante welfare. And that is important because it shows that implementation of monetary policy, the mechanism used by central banks to inject liquidity in the economy, is an integral part of monetary policy. And we should think carefully about that. Thank you.
Thank you.
Okay, so this is what Francesca and her co-author are trying to do here. So the model of floor system, where basically in theory at least, the overnight rate is determined by the interest rate on reserves. You have a load of reserves in the system, and financial arbitrage should dictate that the interest rate that the central bank pays on reserves should determine the overnight rate. In practice, there's a lot going on there. That's not quite true. But we won't get into all that here. But the vehicle for thinking about this is going to be a version of a Lagos-Wright type model with unsecured credit. The basic policy issue is going to have to do with the effects of these voluntary reserve targets. Okay, so just some background. So first of all, floor systems, still pretty common in central banks to think about this in terms of kind of a pool type model. When I was working in the Fed system, I saw this any number of times and seen it a lot since. So there's still a work done, and in sort of variations of that framework. It looks like this. So this is like what Poole did. This is like 1968. He was thinking about a partial equilibrium model of how the Fed funds market works, and he makes particular assumptions about an individual bank that can trade, and then there's some uncertainty that gets resolved in a particular way, and what he derives is this downward sloping demand for reserves at the individual bank level. So on the vertical axis is basically the Fed funds rate, and the horizontal axis is quantity of reserves demanded by this particular bank. And RM here is the interest rate on reserve balances, and there's some point in this where this demand curve becomes flat, and then people like to think a lot about like Q star, what the critical threshold is, where you move from the corridor system to the floor system, given the kind of the trivial thing to do here to make this kind of partial equilibrium models, to put the supply in there, which is just Fed determining sort of a vertical supply function for reserve balances. So that's kind of the way that works. And so what are the issues with the Poole model? It's a whole lot that it's leaving out. It's partial equilibrium. It's kind of static model. Really kind of two period setup. What about secured overnight credit? That's pretty important. We know that even back in the days when the Fed was intervening in a corridor system, that they didn't intervene in the Fed funds market. They intervened in the repo market, and the idea was there's some relationship between the two markets, and repo market's pretty important. We were talking about some about that earlier today. That's not in there. There's kind of not an adequate treatment, I think, of central bank intervention. So Francesca and Garth, they're improving on that. So they're looking at a general equilibrium framework. It's dynamic, and in a world where you can think about welfare consequences of policy. Great, so that's really good. Now they're leaving out the secured credit, and maybe they kind of fall short in terms of capturing the role of the central bank. I say fall short, so it's like kind of this is kind of dreaming about what you might do. So some of these things are just hard, as it is pretty hard. It's a hard paper to get through. It's hard to work out all the results. I certainly didn't check everything. So these are like hard problems, and this, particularly this thing, like trying to deal with like the secured and unsecured credit together. Woo, it's like maybe somebody will figure out a simple solution, but I certainly haven't been able to do it. So now the kind of background on the policy intervention they're going to think about. So as far as I know, nobody actually does this. There isn't a central bank that does this voluntary reserve targeting. Maybe somebody can correct me, but I don't think anybody's done it. But they're related things. So there's reserve tiering. So basically, it's like the voluntary reserve targeting arrangement they're thinking about is in a class of like piecewise linear remuneration for reserves. So here's an example. So Yeah, what are we looking at here? So we're looking at basically remuneration as a function of total reserve balances for an individual bank. So the yellow there, oh, sorry, not yellow, orange. Orange is what Francesca was talking about. That's the voluntary reserve targeting. T is the target in her framework. So an example of reserve tiering that's been used by, say, by ECB, Bank of Japan, and Swiss National Bank. That's something that they started doing, like in a world with or in a regime with negative interest on central bank reserves. So the blue is like what the Swiss National Bank was doing during this period of negative interest on reserve balances. So they paid, the bank would incur zero costs up to the threshold, and then they'd start paying a cost to holding reserves. Why did the Swiss National Bank do that? Well, it's because they were thinking about bank profits, thinking, well, maybe these banks are useful for something, and the banks are complaining, and this negative interest payment is essentially a tax on banks. So the idea is that the marginal interest rate they're paying will determine the overnight rate, and then they'll kind of shore up bank profits or something like that. Well, so then in late 2020, in response to like high inflation, not as high in Switzerland as say over here, but they raised interest rates above. They went positive. So the kind of schedule they were using is, and what's in place now is yellow. So it's like now you get positive interest on balances up to the threshold, and then you get zero. So now the notion is different now. So now what they're trying to do is more related to what Francesca's talking about, because the idea is that they don't want the overnight rate to be the marginal rate these banks are paying, which is zero. They want it to be the rate that determines the slope of the lower portion there. So so basically what they do is this thing's coupled with they say open market operations, but as far as I can tell, it kind of looks like the Fed's reverse repo facility. They're trying to suck reserves out of the system so that they get the right overnight rate. So the question is, well, why are they doing this? They're doing it because they want trade in the overnight market. You could question, whether that makes any sense or not, but it's related to what Francesca's talking about. So maybe that's a rationale for what they're doing. It's not what they were thinking about, but they want trade in the overnight market. Okay, so yeah, that's stuff I already said. Okay, so how does this model work that Francesca and Garth worked on? Okay, so part of it's just kind of conventional Lagos Wright kind of monetary theory setup. It's got an extra sub period in it. So there's this money market period with where there's a credit market. But it kind of looks like part of it looks like something that Berenson, Camera, and Waller worked on. But they didn't have this kind of limited commitment setup, which is that's going to be critical for how the voluntary reserve targeting works. So that's really important. So that's something they're contributing here. Okay, so you've got single asset. This is just this money, which we're going to interpret as reserves, and the stuff pays interest. And you start off with there's a settlement market. That's Volrasian market. Assets get traded, debts get settled. Then this money market. So they're going to be buyers and sellers in this final market that they call the investment market in the paper. So so there's going to be buyers and sellers there, but the buyer's going to get a preference shock, which they don't know when they're in the settle market, but they learn it in the money market. So at that stage, there's going to be heterogeneous buyers. Some are really hungry for consumption in the following investment market, and some are not so hungry. The not so hungry ones are going to be the lenders in the money market, and the really hungry ones are going to be borrowers in general. And then this investment market is competitive. So some of the Lagos rate setups, they'll have random matching in there. That doesn't matter so much. But anyways, competitive markets where goods and money are exchanged. And then that money market it's a credit market where you're exchanging money for claims on goods in the next settlement market. Okay. And then when you settle your debt in the settlement market, so you're this buyer who took out credit in the previous money market, you're going to settle in the settlement market naturally, and there's limited commitment. So you can run off if you want, but if you do, you're gonna face exclusion from future money markets. You can do other stuff, right? So we could allow for equilibrium where you're punished in different ways, but the particular punishment here is it'll allow you to still participate in the settlement market. So you can still hold money and trade in the investment market, but you can't participate in this credit market. And then we got monetary policy. So monetary policy here is there's interest on reserves, and there's determination of a money growth rate. But that's really only it's really only one instrument, because it's the difference that matters. It's effectively what the central bank is doing here is determining the real rate of return on the money. Okay. So what's going to happen is higher real rate of interest is going to discourage lending in the money market. So this is sort of the interesting part. Is that it's going to work like floor systems work, where if you're a lender in this credit market, you can lend to the central bank too. So that's going to put a floor on what the interest rate is, and if the floor is high enough, it just going to cut out trade in this credit market altogether. So the one issue with this is that it's not tied to the banks, to the central bank's balance sheet, which you might like. Yeah, maybe you can't do everything, but it's and then maybe it looks more like a model of retail payments than wholesale payments. The voluntary reserve targeting. So again, part of what's different about this is that the bank chooses its target. It's not like the Swiss National Bank that gives you the target. You determine it yourself as a bank or as an agent in this model. There's an example shows how that can improve welfare. It works by affecting the off equilibrium penalty. It's tied in with kind of giving you more trade in the credit market. So it relaxes incentive constraints and relaxes or increases debt limits. That improves welfare. Okay, so issues. So the negative stuff, so like some of the interpretation is you kind of have to stretch. There's something called investment. Maybe it doesn't look so much like investment. You might like a better story about banking and, some of the things that look more like banks and the central bank intervention and the secured credit market, all which may kind of maybe too complicated anyway. But this is kind of like dreams, dreams for what we like to know about. Positive things are, it's an important problem to be working on. There's not enough people, I think, working on things like this, and they do a nice job of kind of putting together available tools and doing that in a constructive way and coming up with serious policy evaluation. That's it.
Thank you, Steve. Okay, so we're a bit over time. I don't know if there's one question, and then we'll give time for Francesca to answer.
So that was a great paper. My question is the following. Sort of what you touted as the benefit is you're saving on costly money. But money doesn't have to be costly. That's created by the government. So one of the things, for free essentially. So one of the things that I was thinking is it would be nice to have an experiment where at least you fix the amount of revenues that the government gets. Can I reshuffle these rates around and do the voluntary reserve target so I can improve the economy without lowering the inflation tax revenues? And a bigger project would be, is there a reason to go away from the Friedman rule? But that's kind of maybe not for this paper, but it certainly is in the background.
Yeah, so I think in addition to being like an ample reserve environment where you see a big reduction in the unsecured interbank rates, it also seems like the post-crisis liquidity regulation has been the last straw to also kill the interbank markets, given the expected runoff rate assumption on the unsecured borrowing from financial institutions is equal to 100%. Like Goldman can now borrow from like JP and then lend to Deutsche Bank infinitely. Otherwise, it's going to run against its LCR constraint with 100% of certainty, right? So just want to think about the world. Like what's wrong with the world where everything is secured in terms of interbank transactions and the central bank also targets the repo rate, which is pretty common as well.
Francesca?
Yeah, thank you very much. Thanks for the discussions, Steve. I didn't know about the BOJ and SMBs, and so thank you. Yes, the point about secure markets, I totally get it. I think here all that we wanted to highlight is that even if you have secure markets, access to those markets is costly because you have to get collateral and there's opportunity cost of using that collateral. And there has been historically value in accessing these unsecured markets. We have seen it in the US, we have seen it in Europe, and other places like the Norwegian Central Bank. So that's why we sort of focused on that, but I take your points. That's perfectly legitimate. With respect, I'm just going to start from Wang's point on the LCR. I agree with you. I think my sense, however, is that so research from board colleagues shows that data show that exactly the LCR is actually what makes some large banks borrow. So large banks at the moment in the federal funds market are both lenders because they tend to be custodian banks, bankers banks, correspondent banks, but they're also borrowers because of the LCR. So they need to borrow from somebody who's not subject to that LCR constraint. So in the unsecured federal funds market, the LCR at the moment seems to be a reason why trade is actually taking place. So there is some of that in here already. The other point that Marco brought up about the comparing fixing revenues and comparing VRT versus flat rate. So we had, yes, I think that's important. We have another paper that's on the JMCB, not with endogenous limited commitment. So there's not all that machinery of Keogh-Levin in that paper. That's a paper where we studied VRT in more detail, and in particular, we highlight the sort of beneficial nature of the fact that due to the endogenous adjustment of targets, you're effectively creating an environment with scarce reserves for whatever amount of reserves there are in the economy. Because banks, with that remuneration schedule that I showed you, are going to want to choose targets to equal their expected reserve holdings. Because if they choose 0, they're going to give up on the remuneration of the target that is higher. But if they choose infinity, they're going to be charged the penalty. So they want to be somewhere in there, ideally. And the sort of clever idea of the BRT is that regardless of how many reserves you have in the economy, that voluntary nature of the target makes you look like you're in a scarce reserve regime, even if you have abundant reserves, basically. That's what we do in that paper. And because our point is describing how this framework works, we compare the cost of this framework to the central bank with respect to a framework of interest on reserve balances and overnight reverse repo. So we characterize sufficient conditions such that one is cheaper than the other one, and so on. But to be fair, there's no limited commitment in there. But I do agree that is a good point. Whether it's good to be away from the Friedman rule or not, yeah, I think that's a good question. I think here, the stand that I'm taking, that we're taking, is that it may be good to be away from the Friedman rule. Well, okay, so in this model, if you are at the Friedman rule, you have no issues whatsoever. So, point well taken. This is not a model where you are at the Friedman rule, and I can talk about credit, right? And so one should twist this model or think about a slightly different model. But the idea that I have in mind with how my gut feeling reaction to that valued point is that credit is valuable because of that efficient reallocation of liquidity that can happen. Instead of being self-insured, shocks can happen that to the amount of liquidity, the way in which markets function, that might impede that abundance reserves to be making agents have all the money, real money balances that they need in all states of the world, basically. And when crap happens and you have September 2019 or some regulation that is introduced, some other mistakes by governments or other shocks, that's where you want access to the money market or to credit. And that reshuffling of liquidity is valuable. But I need a different model to see that, because here, if you're at the Friedman rule, you're as happy as in heaven.
Thank you, Francesca. Thank you very much. All right, so the next paper is by Dean Corbe on a quantitative model of banking industry dynamics.
Okay, thank you very much for putting this paper on the program. And thank you to our discussant who, we kept sending him paper after paper after paper right before this. So, all right, so this is with joint work with Pablo and the views of the FRB. These don't necessarily reflect the views of the FRB. So this paper was kind of born out of Ben Bernanke's statement. I want to be very, very clear, too big to fail is one of the biggest problems we face in this country, and we must take action to eliminate too big to fail. And so at the time, the kind of putting banking into kind of macro models, the way it was put in was kind of like, let's say, Gertler-Karate, where there's constant returns to scale, perfect competition, and there's an indeterminate size distribution, like in firms kind of models. But yet, we're thinking about the word too big. So we were kind of saying to ourselves, how do we kind of write down a model where big is determinate? And that's what kind of where this started. So let me just kind of show you a sense of big. And I have to thank Ellen for always, I learned from Ellen to be very careful about the horizontal axis and the vertical axes. So, thank you. All right, so on the horizontal axis is the years, on the left axis is the number of banks, And you can see that, from 1984 down to present, the number of banks has fallen from about 12,000 to a little over 4,000. The blue line is what's on the right-hand side. That's deposit shares. The blue line is the top 4 deposit share, and the green line is the top 35 deposit shares. And so, you can see that, first of all, at around the time that Bernanke was saying what he was saying, that's when the top 4 deposit share was at its height. And it's currently around 40%. The top 35, it's around 72% or so. And then the remaining 4,000 banks or so, that's about the other 25, 28%. So, what the question is that we kind of want to start thinking about in this framework is what are the macro consequences for financial stability and lending from too big to fail policies in a world where there is this kind of changing market structure. So what I'm going to do today is we'll outline, we'll document some banking industry data facts from call report data. I am going to spend more time than probably the Minnesota crowd would like looking at the data, because the way that when we looked at the data, it really influenced the kind of model we were going to write down. So I want you to understand the model we're going to write down through the lens of what I show you with the data. And we're going to have a very simple model. It's a simplified version of some stuff we've done, other things we've done. But it's going to basically have this framework that's called the dominant fringe model, and that's something that Tom Holmes and Gautam Garashankanam had developed in a RAND paper in 2004. And basically it's a world where there's some dominant banks. You can see that, like the top 4, the top 35, and then there's a fringe, that other 4,000. So that's kind of what was kind of getting us to think that maybe this is a good framework for thinking about the banking industry. That model, it's a Stackelberg game, and the big banks are going to compete first in the loan market. That's going to, so anything that happens to one of the big banks, because they're non-atomistic, is going to spill over to small banks, okay? So there are going to be these spillover effects. It's not going to be coming through balance sheet effects or things like that. It's going to be coming through strategic interactions in the loan market. We're going to estimate parameters and validate the model through untargeted moments. I mean, one that's kind of fun is to think about the competition stability hypothesis, whether or not, as competition rises, it makes the banking sector more stable or less stable. It's a big empirical literature on that, and we'll kind of say, how does our model do along that dimension, for instance? We don't target that or anything like that. And then I'll end with doing a too big to fail policy counterfactual. Okay, so here's some evidence, at least, for imperfect competition. So the first one, again, it's going to be across, horizontal axis is going to be across years. But this is just a graph of the Herfindahl index, which is just another version of a kind of a concentration index. And I guess the part that I want you to take a look at on the right-hand scale is the Herfindahl at the state level. And, it starts in 1994. I should say, just for those people who may not know this, but, before 1994, there was, in 1994, Regal-Neal got passed at the national level. And so before that, there were state-level restrictions on branching across state lines. And so you start to see this huge run-up, right, in Herfindahls and in concentration in the previous slides past that time, okay? And then, at the state level, that's on the blue on the right-hand side, anything above 1,500 is considered mildly concentrated. And if a merger was to take place above 1,500 and raise the Herfindahl by 100, the antitrust department starts to kick in, okay? And they start thinking about whether that's a good thing or not. This is just a picture of what's called the Ross-Panzer H statistic. And what the H statistic is basically a statistic that measures pass-through of changes in costs, input costs and things like that to, let's call it like output prices. So a measure of pass-through, in perfect competition, that's supposed to be 100. It's well below 100. And then the other thing to kind of take away from this, the blue is the pass-through of the top four. And you see the pass-through of the top four, they're not passing through the way that the rest do. So, the rest is more competitive. There's less pass-through along those. And then this is a figure, markups have become like a really big thing lately. And so this is just measures of markups. Taken from this, you see the rise in markups across time that's kind of shadowing, you saw concentration rising across time, here's markups rising across time. And you see the markups for the top 35 banks are higher for the most part than the median banks. So, we kind of want to think about that as providing some evidence. Nothing's conclusive, but for imperfect competition. There's something called Zipf's law. So Zipf's law is basically, and this is typically done for non-financial firms, they found that the firm size distribution was basically kind of well approximated by a power law distribution. In these graphs, on the left-hand side in the horizontal axis, you're ranking banks by their size of deposits, for instance, and then based upon the vertical axis, it's how many deposits they have. So, if you go out and estimate, this simple equation on D is equal to B times R to the minus alpha, you should be estimating the alpha coefficient to be something like 1. That's what Zipf's law predicts. We find that it's a lot higher than 1. And what's also interesting is you see in the top panel is what was before Riegel-Neal, and the bottom panel, was like quite a bit after Riegel-Neal. And you see, the switch, those bigger banks kind of taking more of the market share. The next thing is about geographic expansion across states. So again, this is 19, the years are in the horizontal axis. And what we did was take, like FDIC data and, just trace for the top 4 banks, which is in blue. That's the number of states that they're in with active branches. The top 35, excluding the top 4, is in red. And then, the fringe is basically in like 1.1 states, okay? So, the key takeaway that we want you to kind of see from something like this is how big banks have kind of geographically diversified themselves. And then, so what does that geographic diversification get you? So, what we did was we took, from the data, we kind of run, we estimate basically a Markov process for banks of different sizes. So the top 4 banks being, those big banks. And what I want you, the last column is just basically a measure of the variance of the deposit inflows. And so what you see is that for the top 4 banks, they have a smaller variance of deposit inflows. For the fringe banks, it's almost 3 times more, okay? So you see that the, deposit inflows are the variance of those are increasing for smaller banks. And so, it's just kind of consistent with big banks having a geographically diversified pool of funding, and less volatile funding inflows. This is going to be a process that we're going to feed into our model, okay? What else? Some evidence for increasing returns to scale, okay? So I guess I'll just focus on what you see, marginal net expenses, which is the, so we're measuring cost here. You see that the marginal expenses are decreasing in the size of banks. And then the last column is just basically the average with respect to both the marginals and the fixed costs. And you see, decreasing average costs across the size distribution. Yeah.
Everybody will hear me. Do you think these banks offer the same services and products?
No, that's a great question. So I think there's horizontal diversification too, and that's going to get caught up in some of these numbers. Yeah. So some of them, we're not going to have horizontal differentiation. It's a wonderful thing to put into the next stage. All right. What we see is countercyclical failure rates and size-dependent bank entry and exit. I'm not going to spend a lot of time on this. Basically, this is just, you can think about failure rates. There's also a measure called the problem bank rate from the FDIC. The failure rate is, and the correlation with GDP is it's countercyclical. It's 0.6 minus 0.162, much higher for the problem bank rate. If you were to look at most of the exit that's happening here is happening through small banks. I don't have the time to kind of go through that. I will just say, and because we're going to calibrate certain parts of the data, but this is also kind of, this number 7 is also consistent with some of the ideas behind the diversification part. So the standard deviation of charge-off rates, default frequencies, loan returns, net interest margins, loan interest rates, loan interest spreads, and the net marginal cost decline with bank size. And then, so that's all, we find statistically significant, differences, but we find statistically insignificant differences in the cost of deposits, loan interest rates, and then, the return on securities that these that banks are facing. But we do, again, find statistically significant changes, differences across bank size and markups. And then finally, we document countercyclical charge-offs, net interest margins, and markups. So that's my summary of the data. And now I want to kind of, through what we just learned about the data, I want to kind of think a little bit about what kind of model we want to write down, okay? So I think, Doug's paper on delegated monitoring, this is like a nice, an important part of that is is diversification and increasing returns. So that's going to play a role. We're going to think about our model. There's going to be a monitoring of loan projects, and that's going to be one piece of the model. We're going to, the fact that we see all this rising market shares and markups, some evidence for imperfect competition, that's what's going to motivate us to write down this kind of dominant fringe model. There is rising loan market competition from non-banks. Tomasz has papers with other co-authors, and we're going to add that into the model, because anything, like kind of regulatory problems, we want to kind of think about the effects of regulatory arbitrage on the economy. And then we're going to put in business cycle dynamics. Now, let me just kind of say as well, in this kind of a model where you have non-atomistic banks that get idiosyncratic shocks, you have aggregate uncertainty basically anyway. So it's not a big deal to kind of we're going to have to do something to think about how aggregate shocks affect the bank size distribution anyway, because we have idiosyncratic shocks to big banks. So we add in an aggregate shock as well. Okay, that's it. Okay, so here's the model. Again, this is like simplistic, very, very simplistic. So we're going to have two regions. Just think of them as east and west. And then in each period and region, banks are going to intermediate between large numbers of households who can deposit at a bank with deposit insurance, hold a portfolio of bank stocks, and inject equity to banks and non-banks. So basically, you know, because all I'm going to do today in the paper, there's all this other stuff. There's households, there's borrowers, but I'm going to show you the banking problem because that's kind of all the time I'm going to have. Think of the households, that's who's going to be supplying the deposits. Borrowers are going to have a large risky project. That's kind of like households are small, borrowers are large. That's kind of the reason why you need a lot of households to fund a large project in Doug's work. By the way, also Steve's work. And so borrowers here are going to have a large risky project and they decide whether or not to take a loan from a bank or a non-bank. That gets at the the market. So we'll be tracking market shares. We want the model to be consistent with market shares of the shadow banking or non-bank sector and the commercial banking sector. And then and there's going to be, you have to monitor the project, or else the people can say, I got the worst possible realization. If you pay the cost and do that, then you get to know which realization they actually did. But those borrowers are going to give us a well-defined loan demand curve. The banking sector is going to be, there's going to be dominant national and regional banks. They're going to compete with fringe banks. And that's where the loan supply and deposit demand are going to be. The dominant banks are going to internalize their effect on their own loan return. So they think about how are they going to affect the interest rate that they're facing. It also, because of the borrower problem, there's a risk shifting effect there, which endogenizes, depending upon the interest rate that borrowers are facing. You can have if they get if they face a high interest rate, you could get adverse selection. Okay, you can get negative selection and higher interest rates or higher default rates, and so that's going to be endogenous in the model. So no matter the default frequencies here are going to depend both upon the aggregate state of the world, the regional shocks, but also about this endogenous component, and along that dimension. The sort of the static payoff function is a little bit along the lines of work that Allen and Gale did and Boyd and DiNiccolo did. Boyd and DiNiccolo did here, and Martinez and Rapullo. The inside of the banking problem has elements of that. So. And there's also, deposit insurance is going to create a moral hazard problem for the banks. And then, as I said, we're going to have both aggregate and regional specific shocks. That's going to affect the riskiness of projects, borrower projects, and loan performance. Okay, so. Yeah, no, we just, to keep things simple, we're just looking at there are other papers like Wang. There's a Journal of Finance paper that I think they do both. We're just focusing on the loan market. So there are three types of banks. So the top four, we're thinking of, because they were in so many different states, we're thinking of those as the national banks. The regionals were in something in the middle. And then we're going to call the fringe that like one. Okay, they're taking, they have no market power. They're the atomistic banks. The others are the non-atomistic banks. There's going to be national banks are going to be able to be in both loan markets, but the regional and fringe banks are in just one region. The regional and fringe banks are in one region. It's a very simple balance sheet. This is simpler than the one, our paper in Econometrica, where we actually, and what Rustem was doing, we're not keeping track of equity here, basically. They're going to be paying out, after all profits are going to be paid out as dividends, okay? That's to keep things simple. Our other paper, took that seriously. So the balance sheet is going to be really simple. There's going to be loans. They're going to garner an interest rate that's region-specific, depending upon the different shocks to the regions. There's going to be net securities. So think of if the security is, if A is positive, it's like you're investing in treasuries. If A is negative, you're kind of borrowing on, let's say, an interbank market or something like that. The liabilities are just going to be the deposits, and there are going to be equity injections by households to finance. If a bank has negative profits, and we have imposed the constraint that dividends can't be negative, you have to have a seasoned equity injection to keep them going, okay? And banks face net and fixed operating costs. There's this deposit inflows that follow a size-dependent Markov process. There are entry costs to create national and regional banks. We normalize the fringe one to 0. Bank profits are paid as dividends, and banks can exit with limited liability. Okay, so this looks messier
Dean,
than, yeah.
I'm a little confused with one thing. The fringe guys are competitive, right?
Mm-hmm.
And you have deposit insurance. And you have limited liability. Why aren't those guys getting equity of pretty small borrowing as much as they possibly can? Is there some limit on how much they can borrow?
Yeah, so we're going to kind of think of this almost like a pecking order kind of thing on equity, on costly equity issuance. Okay. And in the model, this is simply to keep things simple. We basically set that equity finance cost sufficiently high that they don't get those equity injections. So that fringe banks are not going to be getting the equity injections.
I know, but what's going on? What are you thinking about? Because with all the moral hazard, and one of the puzzles to me always has been, why aren't these banks basically going crazy? Is it regulation? You're thinking about this as equity insurance costs. Maybe it's regulation or something like that.
Yeah,
right?
I'm just,
okay.
I mean, I'm thinking about it through the lens of, we should talk about this
There's
after.
We'll talk about it.
I thought the answer was there was going to be a capital requirement, and that's what prevents these banks from going crazy.
We decided not to put that in here. All those, in our paper, in our econometric paper, we have all that. But here, we don't have capital requirements in this and all, that would kind of affect that decision as well. That's just to keep.
So then, why aren't banks going crazy and borrowing infinite? If depositors are happy to give them the money.
So they have. I mean, first of all, depositors. So they have a certain amount of deposits. That's coming from the deposit Markov process. That's exogenous.
Okay, that's the answer, I guess.
Okay, but there's also you could conceivably. You could borrow in the securities market, right? Right. So I'll show you the equilibrium. Okay, so at the beginning of the period, the bank makes loans, okay? And then so they make loans LOJ at the beginning of the period. They know their particular deposit inflow. They know their costs. And then they know their individual state. At the end of the period, after things like exit and entry has happened, that potentially changes the cross-sectional distribution of banks. So that's where the aggregate state, I said S prime. So this is evaluating at the end of the period the profits at the end of the period depend both on their individual state and the aggregate state. So the first term, P times RBJ, that's just the return. That's the, in successful states, they get the return interest rate. In unsuccessful states, they lose the lambda is basically associated with the charge-off for banks. Okay, and then there are these marginal costs, C of L, that we were calibrating. I was talking about calibrating to before. But again, this is where this P, it depends not only on the aggregate shocks, the regional specific shocks, but also the risk-taking behavior of the borrowers. That's what this R is. Okay, there's a risk return. Just as in the Allen and Gale stuff and Boyd and DiNiccolo, there's a risk-return trade-off. Okay, you take a high return, it's making, so as R goes up, P goes down. That's a risk-return trade-off that's in the model. Okay, so then, what is end-of-period profits? It's just those revenues minus the costs, and then I can be in the securities market, and then I have to pay my deposits and I have to pay my fixed costs. The national bank gets, to get the revenues from both markets. That's why it's summing over J. And then banks pay dividends. The dividend is going to be the profit. If in fact the profits are negative, then they have to issue equity if they want to stay in. Okay, so there's an exit decision that's going to be endogenous. Okay, how much time do I have? Okay, I'm doing okay. I mean, not so well, but okay. Okay, so this is a dynamic programming problem for the bank. They're going to be choosing. They know their individual state. They know the current aggregate state of the world, and they know what the cross-sectional distribution is at the start of the period, and then they're just choosing, how many loans to make, how many assets to choose. So in some sense, the riskiness of their loan portfolio, everything, the shocks, all these other shocks besides the deposit shock happens at the end of the period. So then that's where they're making this choice of whether or not to exit. So Wx equals 0 is if they don't exit, and Wx equals 1 is if they do exit. There are, basically these balance sheet constraints, and they're recognizing that the loan market clearing, that the big guys are recognizing that their little LOJ, as you integrate all the loan supply in that market, they're going to have an impact on that. Okay. And if they stay in, they pay out dividends, and they move to the next period. If they had negative profits, they have to, get a seasoned equity injection. That's what the D's are, and then just to evaluate what the exit, what they get if they exit. The limited liabilities where you have the max over 0 and this other stuff. So all the costs of selling failed banks and things like that is in this term we call delta, and I don't have enough time to show you all that kind of stuff. Okay, so what is oops, oh, okay. What is so what are we solving for? We have to solve for optimal borrowing risk-taking. That's going to basically induce an aggregate loan demand function, and then they're going to choose, where to put it. We have extreme value shocks on the discrete choice of whether or not to go into to borrow from a bank or a non-bank. Their optimal household deposit and stock choices, they have to be consistent. The banks have to be optimizing. The free entry condition has to be satisfied. And then the law of motion for the banking industry state, we have to take into account, that some banks are exiting and some banks are entering. The non-banks have to choose their loans optimally. There's a vector of interest rates that clear the loan market. It has to be the case that bank stock prices. They're just consistent with bank valuations. And then we have to cover the costs of failing banks with lump sum taxes. Okay, so the calibration we do is, so we estimate, model parameters. There's like 14 parameters that we take from outside of the model. There are 26 parameters that we have to estimate within the model. We kind of match a wide range of moments. We're still, this is the reason why it should have said preliminary instead of incomplete, but it's also probably incomplete. We're still calibrating, okay? So, I think this, you'll see there's a couple of places, well, I'm not going to have the time to show you where, but just trust me, we haven't matched it perfectly yet. And then, we kind of, the top part is what we match, with the model, and then we kind of compare it with other moments that are not targets. Here, let me just again say, the model has, if you kind of take the Gertler karate model, for instance, the banks don't pay dividends until they exogenously exit. And they calibrate the exit rate to 6 years. So, that's a world where you've got no dividends from banks for 6 years. And, our model, we actually have times when banks are not giving out dividends and things like that in this model. 5 minutes, okay. So what, here's where I was saying we haven't, these are statistics that we didn't go out and calibrate to or anything. For the most part we do well, but you can see in the net interest margin and on markups we're off, okay? And that's kind of at this stage, that's why I was saying that if I had time to kind of go through the calibration a little bit, it's just that the countercyclical loan interest rate is more than offset by the procyclical success frequencies we have. And so, we're getting too much in one area and too little in another. This is what I was talking about with, there's this whole industry, empirical industry, that kind of says, that runs kind of like regressions. Sometimes they're cross-country regressions, sometimes they're just cross-state regressions, whatever, that regress like some measure of financial instability, like what's the probability of a crisis happening, okay? Or what's the default frequency, like sort of measures of default frequency in the economy. They regress that on lots of different things, but also on concentration, okay? It's not a great thing to do, but they do it, okay? And all I'll say is, the model is kind of consistent with, so one paper by Beck and others, that they kind of run crisis probabilities on concentration. It's consistent with that. Another paper by Berger and others, they run default frequencies on concentration. The paper's kind of consistent with that. And so this was an untargeted kind of thing. Okay, so I have like 2 minutes, I guess. So what is the counterfactual we do? Well, it's not clear that, so we calibrated the model to a world where there was no guarantee that you were going to be bailed out, okay? Maybe, like if you think about what Bernanke was saying, maybe we should have calibrated to a world where you are, guaranteed. I don't know, but we did it that you're not guaranteed. That's, I mean, there were some big banks that went down during the crisis, right? So anyway, so what we do is we basically say that we introduce, this is the same exact dividend process I had before, except if you set that Greek letter psi or whatever it is to zero, okay? And but if you set that Greek letter to 1, that's the guarantee, okay? So we're just guaranteeing that the government will inject the equity for you, okay? And then this is just like, you know, some of what's going to happen. You know, if you've got this perfect guarantee, the national bank increases its exposure to risk, so it starts increasing. Remember, loans are risky. It starts increasing its loans, you know, that comes at the expense to the smaller regional banks and fringe banks. It's no surprise that, you know, they're probably going to increase their loan supply because they've got this subsidy. But you know, so this increase in loan supply leads to lower interest rates. And then, you know, just because we do have this issue, so because interest rates fall, you actually kind of get positive selection. So you get better borrowers because they have a lower interest rate that they're borrowing at. And so default frequencies actually fall, okay? You know, it turns out that you know, taxes to output, you know, they do go up. You have to cover the big bank. You know, there's infrequent, but they actually do fail, and then have to have this injection. Yeah, so it is coming at the expense of having to pay for this. Okay, so since I have like 1 minute, let me just say, you know, there's a lot of other things we have to still do. I mean, one of the things, because we have this regional kind of structure, and the banks are still non-atomistic, you know, we were just kind of thinking about what happens with the too big to fail policy for the top 4, but you know, we could also run experiments with regard to regional bank failure. That's going to spill over as well because these guys are non-atomistic. You know, we didn't calculate what the normative implications are of this too big to fail policy. You know, the paper has no retained earnings. That's, you know, it was a key simplifying assumption. And it has no growth across bank types. You just kind of come in as a type, okay? We kind of changed, we have another paper where we put in, it's costly to climb almost like a size ladder, and it was to kind of understand how, you know, we got this increasing big banks after following Regal-Neal. You know, I think one of the things that we're working on now, I think it's a very important thing to kind of start thinking about is we don't have this second one that we were talking about with this size ladder, paying for a size ladder. That's not being serious about mergers and acquisitions or anything, and I think that is something that needs to be done seriously. Okay.
Thank you, Dean. The discussant is Luca Gabrieri.
Well, thank you so much for inviting me to discuss this paper. It gave me a chance to continue being a student of Dean and Pablo. I would say that Dean sold some of the modeling work short. This is not a simple model. I would say that it's more a paper that has a shock and awe model. It might be a simplification relative to previous work, but it's still a state-of-the-art model. But there are 3 papers, I would say, in this one paper. You got a whiff of the tour de force that they provide in terms of empirical regularities for banks. This state-of-the-art model is really just capturing complex interactions across large banks and bank types. Here, in terms of bank types, regional and fringe banks, in addition to large banks. And there is what I would say a complex calibration exercise that is coupled with an interesting policy experiment. And so here, at least the way in which the introduction is written now, the focus and the contribution of the paper is really geared toward this assessment of the consequences of imposing an explicit too big to fail guarantee. I'll try to go through these various parts of the paper. Let me start with the empirical part. The unit of observation, given the data set that they're using, is really banks. But should we think about banks, or should we think about the more complex operations that fall within a bank holding company? The largest banks that are really the focus of the paper because of this too big to fail exercise have more complex operations than just the banking outfit. I'm thinking, for instance, about broker-dealers. And these are not just operations that are run separately. These large bank holding companies have a treasury that is supposed to balance risk really across the bank holding company, taking into account the positions of the bank and taking into account the positions that the broker-dealer operations are absorbing. Now, the paper really equates size and geographical span with systemic risk in order to consider the consequences of too big to fail. But complex operations and interconnections that span the financial system can also contribute to systemic risk. And so, for instance, take into account the criteria that are set by the Basel agreements for the GSIB designation, a designation for the largest banks that imposes a higher regulatory burden. So apart from size, there's interconnectedness, complexity, and substitutability within a jurisdiction. So in the paper, they point to an example, or they really ask the reader to think about a large bank being JP Morgan. So what I did is that I just took a snapshot of the JP Morgan operations that are described in the 10K form that public companies have to file with the SEC. And so the last one I could find for JP Morgan was for 2023. But so you can think about a smaller regional bank perhaps having a consumer business operation, the focus of the left-hand side of this table here. But a bank like JP Morgan, as you can see, has much more complex operations. So as I was mentioning, the broker-dealer operations would be falling in these markets and security services as described by JP Morgan. But going beyond that, something that the largest banks have been doing post-GFC is really trying to expand in a new segment of the market, which is the asset and wealth management. So that's another distinguishing characteristic for the largest banks relative to smaller banks. Why were they doing this? Well, fee income is really important from this type of operation, and they saw fee income as a way to diversify their risks. They thought that fee income would be just much less cyclical relative to the other sources of income. This is not something that you find in the smaller banks. Depending on the arrangements, this would just be outside of the bank operations. And so even in the type of regressions that are run in the paper, it would be important to consider data at the bank holding company level rather than data at the bank level. Just to gild the lily, think about this other oval here, commercial banking. A firm like JP Morgan, unlike regional banks, would offer correspondent banking services, trade finance. These are really just operations that are not offered by the smaller banks. Now, this is not the only way in which large banks differ from small banks. Interconnections can really boost the systemic risk. Let me take another example of a US GSIB. Bank of New York Mellon, in many respects, may look like a regional bank, for instance, by the size of the deposits. But this is just a bank that specializes in custodial operations. And because of those custodial operations, it's really just a central node for the US financial system, but I would say for the global financial system. In my fun fact here about a bank like New York Mellon is that it's actually the sole settlement agent for US government debt instruments, think US treasuries. So this really just means that all cash trades or repo trades backed by treasuries have to settle through Bank of New York Mellon. So what's the bottom line? I think if you are really interested in this question of too big to fail, you want to broaden the lens of the analysis to recognize a fuller set of factors influencing systemic risk. Now, are we in a too big to fail environment? As Dean mentioned, the moment matching exercise assumes that the observed data are not influenced by too big to fail policies. So the exercise at the end of the paper that looks at the introduction of an explicit guarantee is built on top of data moments that really, even in the data, are matching a failure rate of the largest banks that is taken to be 0. So already in the model, the large banks aren't failing. And so I find it a little strange that then you are considering an additional explicit guarantee that really just changes the risk structure, but where we weren't seeing, even just by setup, any failure of the largest bank holding companies. So this seems to me a peculiar way of thinking about this particular issue. Should it be the other way around? So in other words, could it be that the zero failure rate that you're targeting as a moment is really just an artifact of implicit or perceived guarantees for the largest banks? Or there could be an alternative hypothesis. So here I'm just trying to give you an idea of the tailoring in regulation that happens across banks of different sizes. If you're familiar with the regulatory system in the US, you'll recognize that Category 1 firms are the GSIBs. So you can see here the plethora of statutory ratios to which they are subject. The smallest banks would be in this other category here. So could it be that the tailoring of regulation is really accounting for the fact that there is a redressing of risk-taking incentives that is resulting in a zero failure rate for Category 1 banks? The model, as Dean mentioned here, does not include this tailoring. The model is really just a part of a broader research agenda. So this is, I think, in order to follow exactly some of the choices, you have to go back to their masterclass econometric paper that came out in 2021. So the approach here is really that of very different from much of the macrofinance literature. It's really to build a rich competitive environment for banks. What's the trade-off? In order to solve it, at some point you need to economize on some other aspects of the model. And so I would say that if I try to put it in the context of the literature, some of the other approaches in the literature that really cannot address any of the questions that Dean and Pablo are tackling made the choice of building on a ready macro model, an RBC-style model, and then grafting on a problem for incomplete markets, the justification of the existence of financial intermediaries. This is a very different approach. I would be a bad discussant if I didn't try to refer to at least a little of my work. At the board, we have many modeling outfits. About 10 years ago, we decided to run a model comparison exercise in which we took just a plethora of different approaches because we have so many modeling outfits in thinking about financial intermediaries and then grafting them on macro models. We coordinated on one exercise, which was let's consider that there is a shortfall in the balance sheet of the intermediaries, and let's trace back the macro consequences of that exercise. So we agreed on a size of a shock, but we had many different assumptions in terms of what the financial sector looks like, and we had different assumptions in terms of what the macro environment looked like. So then we ran basically an exercise in which we varied parameters, and we tried to understand what's more important in determining the macro outcomes of this same shock across models. Is it the details of how we model the financial sector, or is it something else? It turned out to be choices that had nothing to do with the financial sector, the friction elasticity of labor supply, or the details of the capital accumulation process. So what I'm trying to say is that they're tackling a fantastic question. It's mostly the holy grail, but there are so many moving parts or so many facets that are missing from here that I wonder whether you really want to fall back on a question for which the model might be better suited. I have some ideas in that respect. Now, you could go in the direction of adding some horizontal diversification. I think that's just too difficult. But maybe you can consider an alternative experiment. And so in the aftermath of the SVB collapse, deposits actually started flowing away from regional banks towards the largest banks. Maybe it was because of perceptions of an implicit guarantee that would just insulate the largest banks from any trouble. But I mean, what we were reminded of in that episode is that correlated business models can really amp up the systemic risk of regional banks. So that's exactly the kind of model that you have. So why don't you consider this question instead? Instead of too big to fail, maybe you should consider the question of too correlated to fail. Now, the bank term funding program was the response of the Fed to the SVB failure. And it really just allowed banks to pledge Treasury and agency securities at their full value against as collateral for loans. Why not assess this program? It seems to me that you actually have the perfect model for that type of question. And maybe I would leave aside the question of too big to fail for another installment of your amazing model. That's all I have.
We have a couple minutes for questions. Fabrizio?
Dean, about, I thought it was great, really nice model and data, but I missed a little bit what's your punchline in a sense. You started with this lack of competition, it seems less, a lot of evidence for lack of competition, and then it's too big to fail. I'm not clear. I want to say, is it too big to fail helps or makes the problem worse, or is it connected at all to the problem? So how did, just wanted to get overall punchline.
The question that Chari asked basically, which is what prevents these banks from blowing up and get infinite value given that you have all these bailouts and deposit insurance?
Okay. Well, let me start there because Chari started. So, there are these costs of making loans. So and they're increasing the amount of loans you make. So eventually, that's what kind of cuts off that arbitrage kind issue that you were thinking of. I think that, so let me end with yours. I think the idea of, we're not doing the horizontal differentiation, but that's related to, I think, Ellen's question at the beginning. I mean, I think some of when we were doing the data work, you remember there were things like marginal non-interest expenses and marginal non-interest income and things like that. And when we aggregated to the bank holding company just for this part, we were missing a lot of the stuff that Luca was talking about, but I think we probably got a little bit, but I don't know how, we can't kind of tell the difference. Just the one thing about, so in the equilibrium that we found, that when we were calibrating the model, it is true that the large banks were not failing on the equilibrium path, but the existence of the possibility of failing off the equilibrium path was influencing the behavior. You can tell that because when you get rid of the too big to fail, it changes things on the equilibrium path. The tailoring, I think the tailoring part, we kind of did some of that in that Econometrica paper, because we did have size-dependent capital requirements, and we had countercyclical capital requirements. We even had, I think, size-dependent liquidity coverage ratios and stuff like that in that paper. I think the balance sheet short fall, we should definitely kind of think about doing. We could do something like that. The model, definitely, as Luca mentioned, the consequences, the aggregate consequences, we kind of push kind of to the side. And I do agree it would be good to kind of really think about it. We didn't do anything. We have, to keep things simple as well, we basically had risk neutral consumers and stuff like that. So you could just calculate aggregate consumption, and you would get some kind of measure of a normative measure of what, and in that counterfactual, taxes were going up. That's a bad. Project outcomes were going up. That's a good. So there is a quantitative answer to that we should be, and we just ran out of time. We had something like that in the other paper. Yeah, so I do think this question of so in the big picture, I think that trying to think a little bit about the role of competition and financial stability is an important thing to be thinking about. Maybe it's crazy to be thinking about these regressions that are kind of like, I don't know how good the empirical analysis is and stuff, but the idea that, maybe, think about it in terms of if there's bigger banks have higher charter values, that can basically incentivize them to try to keep their charter value. And so, this idea that maybe big can lead to less instability. I think that's a question that would be, that's important to ask.
Thanks everyone for the session. Now we're going to have a reception and then a dinner.